Good day, guys. Welcome to Investment Analysis. The case study we'll be looking at is the semiconductor industry, or just semis for short. This will include entities that develop, design, and manufacture semis, as well as those that make the equipment needed to manufacture the semis. Now, for entities that make the equipment necessary to manufacture semis, comparisons will be made in relation to those entities only. So these companies will be compared to semi entities that only manufacture the semi. Now, for foundries, TMC will be directly compared to Intel, since Intel is the nearest, closest um, competitor, considering Samsung is not listed on the NASDAQ or the New York Stock Exchange. So for TSMC, it will be directly compared to Intel. Important note that some entities, the 2021 financial statements are not yet available. Will probably be available around about the time we finish recording and editing these videos. So we will be using a 3-year period, but the 3-year period ending in the most recent or relevant financial year. Again, how we approach the analysis is that we base the analysis on each of the biggest semi companies based on market share as at the 24th of January 2022. Companies that are listed on the New York Stock Exchange or the NASDAQ and that have a constant supply of audited financial statements. Furthermore, one last admin thing to take care of for the PE ratio of NXP. Now, the PE ratio of NXP is a bit insane. You'll see what I'm talking about when we get to the video of NXP. So we excluded it from the industry average. Okay, good. So that's the admin and the intro out the way. Let's get stuck in. The first company we're looking at is Synopsys. Bit of background, what is Synopsys? Synopsys supplies electronic design automation software that engineers use to design and test semis. It releases IP that can be used as a platform to design semis. So basically offers service and software necessary to develop semis. Getting into the financial performance of Synopsys, you will see that number one, its margins are pretty stable. Highlights that Synopsys has a very mature business model. The margin you will see is slightly below the industry average, which is 18%. However, we'll need to analyze other metrics. So just because it's below, it's actually only slightly below, but just because it's below doesn't make Synopsys a bad company. All right, moving on, you will see the cost of growth is very minimal. And again, this does make sense considering that Synopsys' entire business model is offering silicon as a software. So basically offering its IP and its systems and its software to customers so that they can design their own semis based on Synopsys' IP as well as systems and software. So marginal growth in cost of revenue does not spend that much, when compared to the traditional semi manufacturers. Below the industry average. Industry average is about 9%, so it's below the industry average. Pleasing. R&D has been increasing significantly upward. Now, this again makes sense. It is expected, considering that Synopsys spends on R&D, so its customers does not have to spend on R&D. So it's above the industry average, which is about 10%. It's at 12%, but again, that is expected, so that's not a train smash for me. Going on, as a percentage of revenue, R&D as a percentage of revenue is at 20%. As a percentage of revenue, it's at 35%, where the industry average is 20%. It is expected, considering innovation will drive growth and profitability for Synopsys, and clients will obviously demand cost-effective and innovative solutions. So again, Synopsys spends on R&D, so clients don't have to. But I do expect an above industry average spending on R&D. That is justified. Spending does appear to be justified, considering that Synopsys is returning on average compound rate of 10% over the past 3 years in revenue growth. The industry average is 8%, so costs are justified in driving growth and profitability when you consider that net income is growing at an average of 31%. So net income supports obviously the stable margins as net income has been increasing at a compound rate of 31%. So again, expenses are justified, they are driving growth, there is tight costs are spent when needed to drive both growth in the top and the bottom line. So I am happy with that. Looking at the ROE, the return on equity, Synopsys returns 14%, all right, which is below the industry average of 26%, but again, not a bad thing because invested capital satisfies, it is satisfying, its performance, considering that it is returning some form of return on invested capital. So happy with that. So overall, Synopsys has a fantastic financial performance. It has diversified revenue streams, healthy, stable margins, fair returns, and above industry growth in expenses are justified because they're driving profit at the top bottom line and realizing stable margins. Okay, now go into the financial position. You look at the current ratio, which has been fairly-ish stable. Now the stability is mainly driven by the $1.6 billion in cash it has on its balance sheet. Below industry average, but not a bad thing. Looking at the fact that it has been improving and it has been fairly stable. It's not such a bad thing. I see Synopsys as fairly liquid. Looking at still, with the current ratios, you have to understand that liabilities for Synopsys are mainly driven by deferred revenue. Now, this is income that was received in advance. So, for example, before you perform a service or you supply a customer with a product, they pay you in advance. Now this helps with cash flow. Considering you don't have to wait till months and months after you supply the product or the service. You do have cash in the meantime to fund operations, to fund expenses, so you don't run into a cash flow problem, don't have a hole in your cash flow. So it's basically interest-free loans. It improves financial performance and lowers the financial risk. Um, so when I look at the asset test ratio, again, below the industry average, the industry average is about 1.88, but satisfying, considering that still above 1. It shows me that Synopsys does have enough short-term liquid assets to settle short-term liquid liabilities. And again, remember, liabilities are mainly driven by deferred revenue. So now both these liquidity ratios, as we talked, they are below the industry average, but they do indicate a company that's in a satisfying liquidity position. So they do indicate a company that is in a satisfying liquidity position, maybe below industry average, but again, not a bad thing considering what drives the liability. And furthermore, Synopsys does have enough cash on the balance sheet, a ton of cash, 1.6 billion. And looking at the ratios, they're above 1. It is able to meet its short-term liability as and when they fall due with enough short-term liquid assets. Now, quickly moving on to the inventory days. Inventory days are very good. They are outperforming the industry average. The industry average is 101.39 days, 101.39 days, or just over 101 days. Synopsys on average holds stock for 84 or 85 days, just over 84 days. So it is a good thing, considering most of its peers hold stock for over 101 days, whereas Synopsys only holds stock for about 85 days. Again, considering its business model and the nature of its business, it mainly supplies the software and uses the IP, so you don't expect it to have that much stock. But again, a good thing because below industry average, in this case, below for inventory days below industry average is very good. So a below industry average It's pleasing. It's good because again, it highlights the liquidity of the balance sheet. Synopsys does not have a lot of illiquid assets being inventory on its balance sheet. So when you read the current asset, the asset test ratio, as well as the inventory days, it proves a company that's in very good liquid position. Um, it has good inventory management because it doesn't hold stock for longer than the industry average. There's a lower risk of stock being obsolete because you don't hold stock for that much. There's a less of a burden on your net income margin considering the less stock you hold, or the shorter you hold stock, the less stock you're going to have to pay on holding costs. So overall, liquid company outperforming in terms of inventory days, happy with the liquid balance sheet. Debt to equity below the industry average. The industry average is about 126%. Synopsys on average is about 62%. So this is very good. This is very good because it highlights to me that Synopsys in relation to the industry has less financial risk and has enough capacity on the balance sheet to increase debt should it need to fund operations and to fund expansion and growth. Now, again, remember the debt for Synopsys is mainly driven by the deferred income, which is again basically interest-free loans and are needed to plug a hole in your cash flow to make sure you don't run into cash flow problems. So, considering the fact that debt is mainly driven by interest-free loans, which is deferred revenue, this ratio for me is much better than what it looks. It highlights to me Synopsys has a very, very, very low financial risk. So again, very healthy balance sheet that is liquid, not highly geared, so not substantially financially risky, very good inventory management, and substantial debt capacity that can be grown because you're only at 62%, the industry average is 126%. So we still have a lot of debt capacity to grow debt if needed without actually adding significantly to the financial risk on the balance sheet. So very good. The cash position. First of all, the cash from operations margins has significantly improved. 24, 27, 36%. Both was at 39% below industry average. But I love the fact that it has significantly improved. Synopsys has been significantly improving, growing its ability to convert revenue into cash. At 2021, it's sitting at 36%. The industry average for a whole is 32%. So at 2021, Synopsys is performing above industry average. But overall, it's below. Again, not a bad thing. It's been improving its ability. It does indicate that Synopsys business model, it's a very good business model. It's a business model that can generate cash from operations. I love it. Um, Sufficiency of cash flow on hand has been improving. It's actually above the industry average. The industry average is 0.84. So it's above the industry average. That is very, very, very good. So on average, um, Synopsys has more cash from operations to settle uh, think to settle, activities such as, paying off debt, but doesn't pay off that much considering, the debt is deferred revenue and income received in advance. So it does have enough to do that. It does have enough to pay back shareholders and does have enough to buy capital assets needed to grow the entity. So this efficiency of cash flow is above the industry average. It's been improving. It is very, very good. It is very pleasing. It's very satisfying from an investor point of view. The buyback ratio below the industry average. If you look at the average over the past 3 years, from 2019 to 2021, it's 39%. The industry average is 46%. But you can see Synopsys has from 2019 to 2021 grown how much it returns to shareholders. So Considering the fact that Synopsys is growing both the top and bottom line on the income statement, it's been growing its ability to generate cash flows. It's been improving its liquidity position. Doesn't hold that much debt. Yeah, you understand why it pays that much. It's actually rewarding shareholders for having faith in the company. But at the same time, it's an efficient use of cash. It's not just letting cash burn a hole on the balance sheet, but rewarding some cash effectively to shareholders. So the cash management as well as the cash liquidity point of view, Synopsys can generate cash from its operations and has enough cash generated from these operations on a yearly basis to fund all operations. However, the PE for me at almost 60 is high, considering the industry average is 40. However, Synopsys, it's a good company. You will see, over the past year, performance has been really bad, but there has been a massive correction um, on the Nasdaq as well as the New York Stock Exchange. There has been a massive correction. I actually like this correction, because at 60 the PE is too high for me. But I mean, it is a good company. It's a very, very, very good company, but the PE is just too high. Yes, you're getting a lot for what you're buying, but the PE to me is just high. Moving on. Kla Corporation. Now, Kla Corporation is a semiconductor equipment that designs all the process systems and tools needed to make semis. So this is one of those companies that make the equipment needed to make semis. All right, let's look at the financial performance of KLA. Pretty stable-ish margins. They have been impressive, but they have dipped in 2020. But you have seen a massive, I mean, absolutely massive rebound in 2021. Um, on average, at 28%, KLA has slightly outperformed the industry average, which is at 27%. So that's very decent. The dip can be expected considering COVID lockdown restrictions and disruption to the supply chain. So you do expect a bit of a deterioration, but what's very good is this bounce back, this rebound. That is very, very good. That indicates a very, very well run company. All right. Now the rebound was in main part caused by a number of factors. Number one, there was a reduction in cost of revenue. You look at cost of revenue growth, it's actually been increasing, but at a downward trend. Massive explosion here, but was cut a bit. Again, that to me signifies a company that realized, well, we're spending way too much than we need to. Let's cut it to protect margins, but at the same time grow. All right. So, considering the current climate of COVID and, supply chain disruptions, you do expect, companies just rein in cost a bit where they don't need to. You don't have to spend what you don't need to. R&D, both as a percentage of revenue and the growth of it, has slowed down a bit. R&D growth has slowed down. It's been increasing but at a decreasing rate. Again, 2021, a massive pop. I mean, 2020, massive pop. 2021, and has been there was a bit of a massive decline. So it's been increasing but at a decreasing rate. Okay. However, again, like I said, it is expected considering COVID and the financial impact of that. R&D as a percentage of revenue, however, even though it has been decreasing at an average of 15%, it's still above the industry average, which is 13%. So I'm not gonna worry too much. You're not losing track with competitors. I'm not worried about that, considering you might not need to spend that much on R&D again, given the current economic impact caused by COVID. However, all this decrease for me, I'm happy with it because you decrease costs. So you basically decrease what you need to spend on to protect margins and improve profitability. Now, the movement in revenue, so the growth in revenue has been a bit all over the place. Increase and then decrease. It's been a bit all over the place. Um, However, it is still impressive that given COVID, given the effects of COVID, the entity still managed not only to protect margins and also decreasing costs, but increase sales as well. So, given the current economic environment, given the effects of COVID, you protected your margins by decreasing costs, but you also increase revenue. So that to me is very, very, very impressive. The net income as well has increased significantly, but that can be explained both by the increase in revenue as well as the protection in margin um, strategy that the entity followed being tight cost control. So tight cost control, increasing sales has led to an explosion in net income. Very impressive. Again, given the effects of COVID, highly impressive though. The fact that KLA managed to grow both the top and bottom line. Very, very impressive. Okay, now cost control, as we discussed, was in relation to, was basically a response to protect margins from the deadly effects of COVID. Now, the ROE, the return on equity, is above the industry average. Industry average is about 53%. This has been a so, and the ROE has significantly improved over 2019 to 2021. There's been a significant improvement, and on average, we've outperformed the market. That is very good. That highlights the efficiency of KLA in investing equity in its operations to return above market returns on said investment. So again, very impressive, very good, more than happy. Margins are healthy. Performance has been impressive considering the difficulties caused by COVID for KLA to outperform the industry averages as well as maintain healthy financial performance is very good. It is very good. It highlights a very well-run company and a company that is very strong in its market. Now the financial position. Current ratio outperformed the industry average. The industry average is about 2.9 on average. KLA has a current ratio of about 2.6. So it's a slight underperformance. Nothing to be really worried about. Again, you can be satisfied with the fact that KLA has, $2.5 billion in cash. So even though it's below the industry average, but only slightly, it's still in a good financial position considering that KLA on average has more than almost three times. Looking at the 2018, 2019, it almost has three times the current as the liquid assets to cover to settle current short-term liabilities as and when they fall due. So a company that is in a very strong liquidity position, yes, below industry average, but still in a strong financial position that does not indicate any increase in liquidity risk. Now the asset test ratio, even though again it also underperformed the industry average of about 2.17, not a bad thing considering KLA has got almost two liquid assets, so that's including inventory because inventory is not that liquid. So excluding inventory, you have almost two times the current assets, the short-term assets to settle um, current liabilities as and when they fall due. So again, not a, not a, not a, these ratios, especially the asset test, does show me that there really isn't any increase in liquidity risk. This is a very liquid company. So even though both ratios are below the industry average, so the current ratio and asset test ratio, does not indicate indicate high levels of liquidity risk. The inventory days by far above the industry average. The industry average is about just over 160 days, and KLA on average is holding stock for 216 days. A bit worrying considering KLA holds stock for longer than the industry average. And of course, the longer you hold stock, the more carrying cost you're going to spend, on holding the stock, and that will start to eat into margins. However, when you consider the fact that KLA has been increasing margins, been decreasing costs, it's been increasing both my top and bottom line, that's not really eating into my margin. So the fact that it's holding, it's a bit of a risk. There is a risk of obsolete, inventory being obsolete. So there is a risk of that. There is a bit of a liquidity risk that I'm holding so much stock, but it's not eating into margins, and any risk that does exist. Yes, there's a risk. There's a bit of a heightened risk when compared to the industry, but it's not that much that it will make me, conclude that this inventory days ratio makes the balance sheet of KLA in a worse off liquidity position. So yes, I, I do have concerns. There is an increased risk, but it's not that bad. Okay, now going to the debt to equity ratio. The industry average is 171%. On average, KLA has 230. Yeah, now this indicates a higher gearing risk. This is a higher financial risk on the balance sheet. This is a very, 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 very risky entity for me, just by seeing this. Considering all the liquidity ratios that underperform the industry, again, doesn't highlight the massive liquidity risk, but considering that they've underperformed coupled with the debt to equity ratio that's way above the industry average, that all adds the financial risk of the balance sheet. So the financial risk of KLA is quite high when compared to peers. Now, what I want you to see is that the relationship between risk being debt to equity and return being return on equity. There's a productive risk. Yes, there's an increased risk, but I also have yes, there's an increased risk above the industry average, but yes, there increased returns above the industry average. So there's a productive relationship between risk and return. So yeah, KLA is very productive in utilizing, capital invested to, provide or earn returns on said capital invested. But again, quite risky for me. Again, this will be, how do you say, investor dependent. Some investors, they might like this, but for me, this is just too risky for me. Even though there is a productive relationship, just too risky. All right. So again, looking at KLA's financial position, it does have a healthy-ish balance sheet. However, it does maximize its capital invested, to achieve returns. But it has underperformed quite a few ratios, and all of that considering just makes it a bit of a financial risk. Just makes it too risky from a balance sheet point of view. All right, now the cash position. The cash margin, very pleasing. It's stable. Again, the increase supported by the strong, the strong margins, tight cost control as well as increasing both the top and the bottom line. The industry average is 26%, so on average, KLA is at 29%, so it's overperforming on that. That is very good. So stable margins that are outperforming the industry average. That is very, very pleasing, very satisfying. The sufficiency of cash flow has been improving, to a point where in 2021 it's above 1. The industry average is 0.66. So at an average of 0.71, that is wickedly impressive. Um, and again, the increase does make sense. It is supported by the growing margins, the fact that so the growing cash margins, the fact that KLA can convert revenue into actual cash that it will then use to fund operations, and KLA does have more than enough, actually above the industry average, to fund all operations. So a very good and appropriate ratio in my point of view. Now the return to shareholders. Now this is the total return to shareholders. This will include dividends and buyback. So KLA does, the KLA does engage in dividends and buyback. KLA is very good. It's a very good margin. It's a very good yield that returns to shareholders. Very pleasing. Yeah, does not let excess cash burn a hole in the balance sheet, but rather uses that excess cash and returns it to cash to shareholders. So a very efficient use of cash in my point of view. Good cash management. So strong margins, enough cash to fund all operations. Yeah, that to me is very good. You're spending enough and you have enough to fund operations. Might as well give shareholders that excess cash. So again, a very good ratio for me. Very good. The PE at 26.8, almost 27. It's actually below the industry average. It's actually, sorry, above the industry average of 23.26. So, you know, above the industry average, but by not that much. It is a relatively cheap stock, relatively cheap. Again, even though the average is 23, over 23, and it's at 26, I'm, I'm not too worried about that. So I consider it relatively cheap, but there's just too much risk. It's just too much of a risky entity, considering you've got debt to equity in excess of 200%, and you're underperforming the industry a bit in the liquidity ratio. So it's a bit of a risky for me, too risky for my blood. But for some shareholders like this, they might say, "Nah, you're getting way too much, and the risk is tolerable." But for me, the risk is just a bit too much above my risk appetite. Decrease in over the past year, but again expected since the stock market has been going through a bit of a reprice. Microchip Technology. So Microchip Technology is a developer, manufacturer, and seller of semis that are used in a variety of applications, from the Internet of Things to motor vehicles and other smart devices and technologies. First thing that pops up, that hits you square on the face is the low margin. That's a pretty tight margin. But considering the fact that Microchip does operate in a highly competitive sector of the semi industries, tight margins are the norm. By the way, at 4% average, the margins are underperforming the industry of about 18. The industry average is about 18%, so by far underperforming the industry average. But you need to consider the kind of business Microchip is. Microchip, it operates in a very highly competitive sector of the semi industry. So low margins are kind of the norm in that sector of the industry. However, in the face of this aggressive competition and of course deteriorating market caused by COVID, as we know, it is impressive, and the Microchip has to be commended that it has grown margins. The margins have been growing, like slightly to 2021, but massive increase in 2021. So slight decrease in 2020, but a massive pop in 2021. Okay, so they are keeping So the fact that they kept margins stable, they need to be commended for this. Now, cost of revenue growth has been decreasing at a downward trend. Again, this goes all into the fact that it does operate in a very highly competitive market. So it is advisable, it is wise, and you can see by the performance of costs that you know obtaining a higher return on low costs is is necessary to optimize growth in net income or to optimize profitability. So again, the high competition, the effects of COVID, you can understand why margins have been declining at such a why the growth in revenue, why the growth in cost of revenue has been declining. It was just basically to protect margins and um, really not spend what's not needed. All right, now good cost control. You're trying to eliminate the effect of COVID as well as trying to make your product as cheap as possible. To basically starve off competition. Now R&D as well has decreased at a downward rate, same as cost of revenue growth. For the same reasons. You're really trying to reduce your cost of production, the cost of manufacturing, trying to reduce them so that you can achieve profitability, to give the lowest price because you operate in a highly competitive market to give the lowest price to maintain your share of the market and improve your profitability. Now R&D as a percentage of revenue fairly stable, fairly stable. Not much complaints about that. Even though you want to reduce costs, you still don't want to lose track with the big boys. You don't want to lose track with your competitors. So the fact that R&D has been stable, that's pleasing to me, considering the market you operate in. So fairly stable spending on R&D. Now the revenue growth you will see is a bit mediocre, especially in 2021. In 2020 it was a negative. You actually lost money, a lot of it. But fairly understandable. Heavy competition and COVID is just wreaking havoc on companies' operations, on Microchip's operations. Now, net income has been on a bit of a downward trend for the past 2 years, but it grew significantly in 2021, and this is as a result of course, tightening cost control. Even though revenue increased by 3%, but I think but most of the growth, it can be attributable, yes, to the growth in revenue, but also to the tight cost control, to the fact that you're reining in costs. So you reined in costs to protect margins as margins grew, as well as to grow revenue, even though it's mediocre, but you grew revenue as well as you exploded your net income. You grew it by 126%. So tight cost control, increase in revenue, all led to an explosion in growth in net income. Very good. Return on equity makes sense. Um, it it is a bit mediocre, uh, but again, the entity needs to be commended. The fact that it grew not only its margins but its ROE in the face of mounting competition as well as the heavy effects caused by COVID. So again, expected considering you've got such low margin that your ROE kind of expected that it will follow that. Low margins, but healthy financial position. Um, that is good. That is very, very good. So in the face of mounting challenges, Microchip has to be commended that it grew both the top and the bottom line. And it has stable operations. So it grew even in the face of very, very difficult operating environment. Now, the financial position. Now, the current ratio is way below the industry average of about 2.37, way, way below. I'm a bit worried about that. I'm very worried about that. Um, the same applies for the asset test, which is also below the industry average. Industry average is about 1.88. Um, yeah, like both these ratios, they worry me a bit, because these are a measure of your liquidity. And they do worry me a bit considering you're underperforming the industry. In 2021, you have less than one. So there's an increased liquidity risk in my view on Microchip's balance sheet. The inventory days are on average above the industry average. Industry average is just over 101 days. On average, Microchip is sitting at 116 days, just over 116 days. So very, very worrying. Um, so there has been a bit of a fluctuation, as you can see. To a degree caused by COVID. The fact that you're holding on to stock far longer than you need to because uh, of the supply chain problems, uh, competition as well. COVID just made everything worse, but heavy competition as well. So that is worrying because reading all of these liquidity measures, reading them all together, you don't have, Microchip does not have enough current assets and enough liquid current assets to settle current liabilities as and when they fall due. On top of that, you hold way too much stock than you need to compared to the industry. So you're holding on to stock for far longer. Now, holding on to stock far longer increases the risk of the stock being obsolete. It does burden the balance. It does burden your bottom line because you have to spend more holding costs. There is an increase in holding costs through holding an increased amount of inventory. So this is worrying, from a liquidity point of view. Microchip's balance sheet is not attractive. There's an increase in liquidity risk. It's underperforming the industry average on all metrics. So this to me scares me and it does put me off Microchip. Now the debt to equity is very high considering the industry average 126. So this highlights to me an increase in various. This highlights to me an increase in financial risk. So you know, COVID clearly has wrecked this company. It has wrecked Microchip. Competition as well hasn't been kind to it, but you know, the low liquidity and the high debt levels combined with the fact that you've got very low margins, mediocre growth, very, very low return on ROE, all of that just paints to me a very unattractive company. You know, uh, the financial position is a bit hot and cold. The balance sheet to me is very unattractive. The increase in days, coupled with the current ratio as well as the asset test, all of those underperformance just highlight a very, very risky company that not really providing me with the returns that I'm looking for, higher than usual debt levels. So this is a no for me. Now, the cash position. All right. I mean, the cash position of Microchip is very, very good. Actually, very, very good. Uh, Pretty much stable, but in 2021 has been increased significantly. So what this tells me is a company that can convert revenue into cash. So on average, for each dollar of revenue Microchip generates, is able to convert 35 cents, or about 35% of all revenue made is converted into cash. In line with the industry average is about 32%, and Microchip has performed pretty much in line with that industry average. So, so a good cash from operations margin, very good, in line with industry average, that is satisfying. However, the sufficiency of cash flow does paint a bit of a worrying picture. Industry average is 0.84, and on average, Microchip is at 0.28. So it is worrying. I mean, it has deteriorated significantly in 2021 and 2020. So it does indicate that yearly, Microchip does not have enough or does not have enough cash from operations to cover or fund operations. Now, this deterioration and this underperformance can mainly be attributable to the fact that it is borrowing a whole lot, and as a result, it has to pay back a whole lot. So that to me is worrying. To me, it is worrying. It has a decent what is it, buyback ratio. However, P/E is way, way, way too high. Industry average is about 40, or just over 40. And here I'm paying just over 55. So very, very high considering I could get high performing and better companies in the same industry. So Microchip overall, it's a good company in the sense of, it's protected margins, it's grown margins, it's profitable basically. However, the liquidity risk, the finance risk, and the fact that it pays you a lot of money back in the form of debt, and has to always borrow more because it always has a bit of a shortage in cash flow. I mean, it isn't a cash flow positive situation considering that it does make cash. But I'm just, you know, considering I'm paying what, over 55, I'm paying a PE, trading at a P of just 55, and considering that I'm getting not enough liquidity, heightened liquidity risk, heightened financial risk, low margins. Yeah, no, it's not the company for me. Marvell Technology. Now, Marvell is a semiconductor solution provider of high performance data infrastructure, makes any that go into data centers as well as the network infrastructure related to said data centers, i.e., it makes memory and storage sense. Right. Net margin very inconsistent. Look at that. Went from 0 to 30% to negative 11%. Very inconsistent net income margin. Below industry average, which is about 18. Worrying. So the margins are worrying for me. Considering that it does operate in the high margin data center market. Companies tend to have higher margins in this industry, and it is very, 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 very competitive. So you could understand why the margins are so low. It could be, you know, Marvell could be probably cutting prices, right, to be able to compete with some of the big boys. Yeah, but worried, just a bit worried. So it's not a consistently profitable company. So it's important in this stage to determine the path towards profitability. Now, you will see costs have been either increasing at a decreasing rate or are basically flat out being reduced in the form of R&D growth. Even though cost of revenue is up when compared to 2020 and 2021, still at a declining rate considering what it was at 2019. So you understand why this is. You're trying to protect margins from the effect of COVID as well as to remain competitive. So, reducing your cost to be able to give your customers a much more efficient, better price than the competitor, than your competitors, than your peers. So, cost reduction basically a response into protecting margins. Now R&D, pushing towards R&D, it's quite high at 36%. The industry average is about what 20%, and it's at 36%. So the R&D is operating at above industry average. You kind of expect that considering, this is a highly competitive market and they're trying to wrestle some profit away from some of the established players in this market. So you understand the above industry investment in R&D. That's okay. Revenue growth is a bit inconsistent. However, it's in line with the industry average. On average, over the past 3-year period, Marvell has been growing revenues at an average of 8%. Industry average was about 8%. So very good. Very, 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 very good. Well, not very, very good. I guess it's decent. It's in line with industry average. But again, considering the fact that the margins are basically abysmal, you have reduced cost a bit, but that cost investment has at least realized some growth in revenue. Now, just a bit quick, now the poor performance of Marvell can to a degree be blamed on COVID. Um, but certain competitors do have a bit of a rosier picture, so just keep that in mind. I know we're not done with the analysis yet, but you know you need to keep in mind the fact that there has been an increase in spending in digitization. Everything is now on the cloud, and this is the market that Marvell thrives in. Providing these semis that are needed to power data centers, to power this, yeah, what is it, digitization drive. So you would expect I mean, not mind blowing results, but you would expect a bit of a rosier picture. Hmm. But anyway, like I said, COVID can be blamed to a degree, but I would have expected a bit of a better performance. All right, so growth in net income, dismal. I mean, it's at a negative 140. Uh, you know, COVID has affected many companies differently. There's some companies that even though COVID hit, decreased costs, but still managed to protect margins and grow revenue as well as grow net income while remaining competitive. Marvell, it has remained competitive. It has reduced costs. It is growing revenue. The margins are just tanking. They're just tanking. So COVID really was not kind to this company. Okay, so now, as you say, the net income is negative, but highlights the struggles that Marvell has been experiencing basically to grow revenues at a sufficient enough pace to realize productivity from costs invested to basically grow revenue. So, yeah, uh, not really impressive. I mean, it is a good company, but I'm just not impressed. Now, the ROE just follows the terrible financial performance. The ROE has deteriorated significantly from 2021, sitting at 2%, which is a laughable rate. But it, it does highlight again the inefficiencies of Marvell to make returns on invested equity. It does highlight its troubles. Yeah. Okay, so the financial performance, well, has been abysmal. It highlights Marvell's basically struggles to compete while growing revenues at a sufficient enough pace. Um, but what one can be buoyant about is the fact that costs are pretty much under control. It's not spending for the sake of spending. It is spending with the view of future profitability. Looking at the fact that getting costs under control, but still maintaining a fairly decent investment even though it's decreasing it's still at a fairly stable rate above industry average and still growing revenue, be it small, but it is growing. So it has struggled a bit, Marvel, but it is spending, but not just spending for the sake of spending. It is spending for the sake of profitability. Yes, it's been bad, but you know, when you look at the intention, I think when you look at the future, you will see this a company pivoted towards long-term profitability. So currently bad. It's really, really bad. But what one can be buoyant about is the fact that it does have a bit of a long-term view on future profitability. All right. Now the financial performance. Current ratio. Wow. All right. Now, first, before we get into all of that, it is very important, especially for me, with investing, to make, to determine that even though, a company might not be profitable, determine the path towards profitability. But in addition to the path towards profitability, I need to see a strong balance sheet. Now, the current ratio, starting off with that. Now, the current ratio, the average performance over the past 3-year period, 2019, 2020, 2021, is sitting at 1.95. So just under 2, below industry average of about 2.37. Uh, however, however, I'm not going to throw a hissy fit. You know, I'm not going to throw a hissy fit about it because it's still above 1. Oh man, there has been a deterioration, but that deterioration has been a deterioration. Not happy with that deterioration. However, it's still above 1. And the deterioration is mainly caused the drainage of cash being invested. So a lot of cash has been invested into the business. That's what resulted in basically deterioration because cash on hand has decreased. But at above 1, I'm still happy because it shows me that Marvel does have relatively sufficient enough short-term assets to cover short-term liabilities as and when they fall due. Okay, very good. Very, very, very good. All right, now going on now the situation, like I said, it worries me a bit, but it does have plenty of current assets or short-term assets to cover short-term or current liabilities as and when they fall due. Now the asset test ratio, looking at its average performance over the past 2 years, it's below the industry average. Industry average is about 1.88. But again, a bit of a risk, but not a heightened risk. So it does worry me, but does not turn me off the stock completely. To a point I'm saying, okay, you are in a terrible liquid position. You still have enough liquid assets. So these are assets that can be quickly converted to cash. You still have enough of those to settle your short-term or current liability. So worried, but not too worried. Now the inventory days again supports the fact that Marvel is in a decent liquid position. The inventory days, the industry average over a 3-year period is about 101. It was above 101, just over 101 days. Marvel's average was sitting at 86, just over 86 days. So it's far below the industry average. So this very pleasing because it indicates that Marvell does have low liquidity risk in relation to inventory because it does not hold inventory on its balance sheet for longer than the industry. Right? Now, this is a good sign of good asset management because stock not hold longer for what is needed. Not a lot of stock is held in my not a lot of stuff is held on my balance sheet, basically improving my liquidity as you can see with the asset test ratio, meaning I have enough liquid assets to settle liabilities. So from a liquidity point of view, these two ratios underperform industry average, but this has overperformed industry average. And when I read this, yes, it's underperformance, but is that underperformance worrying? No, not really. Not that worrying. Still has sufficient short-term assets on hand. Doesn't hold inventory for that long. Good asset management. There is a bit of a liquidity risk caused by that current asset ratio, but it's not that much. Now, the fact that the inventory days are below industry average just gets that liquidity risk down. So the liquidity risk is not that high for me. The no, okay, so good. All right, so the debt to equity ratio. Very impressive considering the industry average of 126%. Very good. Now this means that the financial position of Marvell, so the balance sheet, is not that financially risky. It doesn't have a lot of financial risk considering you don't hold that much debt on the balance sheet. So all of these read together. Underperformance, not too, yes, there's a risk, but that risk is brought down by my inventory days and the fact that I don't have that much debt on the balance sheet. It does make this balance sheet just that much attractive to me. Not a really risky balance sheet. The fact that you've got low debt just um, places less pressure on the balance sheet. Right now, the cash position. All right, the cash from operations margin has been increasing. Slight dip in 2020, but a massive pop in 2021. So it has been increasing below the industry average, which is about 32%. But I love the fact that it's been increasing. You know, it does now. This ratio does indicate that on that Marvell in 2021 can convert 28% of its revenue into cash. So it does highlight Marvell's cash generating effectiveness. The fact that the business model does generate cash from its operations is a very good sign. It's a cash generating entity. The sufficiency of cash flow has dramatically improved, and you can understand this dramatic improvement because supported by two factors. Number one, the strong increase in the margin, so the ability to generate cash has been improving, has been increasing. The fact that you don't hold that much debt, so you don't really have a lot of money to pay to debt holders because you don't hold that much debt at the end of the day. So increasing, improving, strong cash margins, low debt has really resulted in this fantastic number that we see in 2021. The sufficiency of cash flow from my point of view, it's really impressive. It's really satisfying. It's pleasing. It's below the industry average on average. The industry average is about 0.84 and we're sitting at 0.51. Yeah, below, yes, there is an underperformance, but I am not going to really throw a temper tantrum considering the improvement in the strong cash generating ability, low debt. This is fantastic. And of course, it's above 1 in 2021, which is saying something considering most companies in the same industry tend to have sufficient cash flow way below 1. So, very good. Very good performance. Alright, so the very good performance. I'm happy with it. Now, the total return to shareholders. Now, this is dividends plus buybacks. Marvell pays dividends and buybacks. You know, very high. It's very high. Which to a degree, I guess could explain its the fact that we will see share price now. Share price is really, really, really done well, and you will see that it will explain the share price because it does pay a lot in terms of cash and dividends. All right. So it operates at a price to sales ratio. Now that makes comparison very difficult considering its peers are operating at a price to earning ratio. So this is a price to sales because it's not making any income, but its competitors are trading at a price at the price to earnings. So it makes comparisons very, very, very difficult. So, but furthermore, the cash position does highlight an entity that is well in a strong cash flow position. It doesn't just burn cash. It does have an operation that does make cash. Operations can make cash. There is a form of sustainability. It's not just burning cash. It does at the end of the day still have enough cash for them to fund all operations needed. So a good cash flow performance. I just don't like that. The fact that it's operating at a private sales, it makes it very, very, very expensive considering competitors are operating at a price to earnings. So the share price, as normal, there has been a bit of a repricing in the market. So most high growth stocks are down, but overall, I think investing in Marvel has to go on your belief as well as your judgment of the metrics. You know, it is a good company, but the fact that it's really not sustainably profitable compared to peers who are, it is to me a bit worrying. The fact that it's operating at a price to sales and competitors operating at a price to earnings, it makes it a meh company. One that I wouldn't invest in immediately, but keep an eye out. Quickly, analog devices. So analog devices designs, manufacture, tests, and market any software and subsystems that leverage high-performing analog signal and digital processing technologies. That was a lot just to say that manufacture systems. Um, design and manufacture systems actually. But anyway, let's move on. The financial performance. So margins have been declining over the past 2 years. However, still above the industry average of about 18%. On average. 2021 is actually 18%, so it's performing more or less in line with the industry average. Now, the decline in margins can predominantly be explained by the havoc caused by COVID as well as the increase in competition. There is a lot of semiconductor companies. That is why I believe that in the coming years we're going to see aggressive consolidation, but however, increasing competition. Furthermore, now the rapid increase in costs, especially in 2021 costs have really ballooned. Especially in 2021, costs have really, really ballooned. Have really eaten into margins, and that's why we saw the fact that decreasing. They have been decreasing, still above industry average on average, still in line with industry average, but they have been decreasing. That can predominantly be blamed by COVID to a degree as well as the explosion in in, uh, in our costs. Now, R&D as a percentage of revenue has more or less remained below the industry average, but it has remained consistent. Right? Now, considering the margins have been declining and profitability has also been declining, you know, the fact that you're not at industry average does worry me just a bit, not too much, not too much, just slight. But considering that your growing revenue shows me that your increasing costs is justified in providing return. Yes, net income is increased by 1%, and that will go along in explaining that the fact that market is declining. But it's still in line with industry average. Costs are providing a return in the form of growth in revenue at 31%, which is very good. On average at 7%, slightly below industry average of 8%, but you can look at that. So you're just below industry average. So 31% growth in revenue supports my increase in costs. Yes, you are below the industry average, but one can say that analog devices is not really losing any track, especially in 2021, not losing any competitive or any market share. Because you are growing revenues at a massive rate. Your costs are justified because they're resulting revenue growth. You're gonna sacrifice bottom line growth just for a bit, just to maintain that, just to maintain your market share. So overall, not bad, a bit worrying, but not bad. So the decrease in the margins, the decrease in the margins, basically can be explained by the fact that revenues have been on the decline. Um, have been on decline, so we're losing market share. But like I said, there has been a massive bounce back in 2021, which shows me that you're throwing away any market share loss. So, you know, the increasing cost to, well, basically satisfy customer demand, improve innovation, just so you don't fall behind from competitors and stop them from stealing any of your market share. The ROE, however, is below the industry average and it has been, well, deteriorating significantly. Whew. Now, again, that can be explained by the deteriorating margin. So that to me below industry average makes sense considering the margins have been declining. So a very bad sign for me. So the effect of profitability can be blamed on COVID a bit, but of course, one will need to consider the fact that competition as well has ravaged analog devices to a point where it has, in a way, responded well. Increased costs, basically, starve out competition. You know, improved revenue to a point where you can say that it's gaining and clawing back any lost market share. The financial position. So the current ratio below the industry average. Industry average is about 2.37. Below the industry average. So now considering the strength of the balance sheet, you could say AD, analog devices, strength is a bit weaker when compared to the industry. The margin has declined, well, has been improving. It has been improving, and this can be attributable to the, well, close to $2 billion in cash that's really driving liquidity. It still, however, does have enough liquid assets. When you look at the ratio, it's still above 1, almost close to 2. So it does have enough short-term assets to cover short-term liabilities as and when they fall due. Now the asset test ratio, same with the current ratio, below industry average. However, it has been improving, so highlighting the strength of the balance sheet to improve liquidity, driven by the almost $2 billion in cash. Even though it's below industry average, I am happy with it. You know, I'm not that disappointed, because even though we don't hold compared to the industry enough liquid assets in the form of current and asset test, the ratios have been improved. So there is strength in liquidity. I love the improvement. I love the levels that they're at. Below industry average, yes, but it's not so below industry average where one can say there is a definite risk of liquidity. There is a risk, but it is very small. All right. Now, furthermore, just back to the asset test ratio, it does show that AD does not hold significant amount of stock and in value terms or in dollar terms. So it is a pleasing sign, a positive sign of good asset management. It's a good sign of asset management. However, when we look at the inventory days, they are well above the industry average. Industry average is about just over 101 days, and they're trading at an average of 128 days. So it is worrying. The fact that you're holding on to stock for far longer than you. So the more you hold stock, that will increase things such as the holding costs. That will eat into margins. Ugh. That will increase liquidity risk in the fact that you might not have enough liquid assets to cover your liability. So it will make the balance sheet from a liquidity point of view less attractive. So even though in dollar terms it might not hold that much, which is a good thing, it does still hold a bit into it does hold a bit, it does hold quite a bit when it does hold stock for longer than the industry average, which does worry me. But why do you need to hold on to stock for so much longer? Again, COVID can be blamed a bit because of supply chain disruption. The fact that you're not shipping out stock quick enough. So, this, you cannot ignore that. It is worrying a bit. It is worrying a bit. It does place a bit of burden on the balance sheet in terms of liquidity. The debt to equity, however, has dramatically improved. I mean, this is very good. I like this. And this will put less of a burden on the balance sheet considering the liquidity is not that good. I mean, it's not awful, it's not a catastrophic end of the world bad, but it is bad. It is pretty bad, you know. And again, depending on the kind of investor you are, you can live with it or you cannot live with it. I can to a degree live with it, considering your growing revenue, your margins aren't that bad, you don't hold that much debt. So I can, to a degree, live with it. So industry average is about 126%. Your average is about 80's average is about 66%. So that is very, very, very good. Shows that AB has been strengthening its balance sheet by reducing debt. Very, very good. Now, cash position. Now the cash flow margin, so the cash from operations margin, has been fairly stable, above the industry average of 32%. Now, a strong indication of AB's ability to generate cash flow from operations, so ability to convert revenue into cash. It's a very strong ability, stable, above industry average. The sufficiency of cash flow margin has deteriorated, but a lot of it can be blamed to the fact that your debt to equity is at 38%. A lot of the situation is due to the fact that you settled a lot of debt, you paid off a lot of debt. I don't have a problem with it considering you have strong cash margin. So you've got a strong business model, that can convert cash from its operation. I don't mind that. I'm happy with it. You've settled a lot of debt. You've also paid off a lot of dividends. That will explain the situation there. On average, it's below the industry average of 0.844. Um, Again, mm, not I'm not gonna complain too much. Considering you paid off debt, you reduced debt to boost the balance sheet. Make the balance sheet stronger in the face of COVID and rising competition. So can live, you can live. So I can live with this. The low efficiency of cash flow. Can live with it. So again, you paid a lot to shareholders, but that can be basically attributed to the fact that AB does not want cash lying unproductively on the balance sheet. So rewarding shareholders is an effective use of it. An effective use of it. Again, considering there are risks. especially with liquidity. There are risks, but it's not a heightened risk to a point where it makes this company completely unattractive. So, decent performance in my view. The PE at 46, above industry average, which is just over 40. Uh, Pretty decent, I'll have to say. So pretty decent, I'll have to say. So, even though a does have a low sufficiency of cash flow, it's not a bad thing considering it has a high cash generating capability, which is above industry levels. Uh, yeah, you know, the decline caused mainly by paying off debt as well as rewarding shareholders, not having unproductive cash like on the balance sheet. So, yeah, it's a decent company, but uh, not my kind of company. I mean, the performance is decent, but just looking at everything, taking everything into account. Yes, you got strong margins. Yes, you do have sufficient cash flow, even though there was a decline, but it can be explained. However, you don't have that much financial risk on the balance sheet because which is pretty low. Liquidity is a bit of a risk for me. Margins have been declining, but there has been enough investment to realize returns in the form of growing revenues. Yeah, I just expected more. So yeah, it's not my kind of company. Overall, it did underperform its peers in some metrics. It's still a good company, but I think I can get a better return somewhere. On semi, manufacture of semis, mainly to the automotive industry, mainly to be supplied to the automotive industry. All right, low profitability margins, as you can see that, and they have been declining. So low profitability margins, but that's because it does operate in a low margin sector of the industry, which is highly competitive, by the way. Deterioration can be explained, in addition to the heightened competition, COVID as well just made everything a bit worse. Car manufacturers, were not manufacturing cars or was suspending a lot of their production capabilities. So Sony did not have the luxury of selling as much semis as we would like to. So the supply chain disruptions really wreaked havoc on its margin. So as a result of COVID, it did impact, as we talked, it did impact profitability, due to low manufacturing capabilities, sell less, make less. Now, looking at the cost of revenue growth as well as the R&D growth, you will see that in the form of, in the case of cost of revenue growth, it has decreased. In the form of R&D growth, it's been decreasing at a downward trend. That does make sense. You're not manufacturing enough. You're not manufacturing as much as you would like. You're not manufacturing as much as you should because of COVID and supply chain disruption. So you're not gonna spend that much on production. So that decrease is understandable. You would have expected the decrease to go along with protecting margins, but it didn't. But the reason why they didn't do that is because sales was very, 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 very poor. You lost money actually. Um, you lost money actually. Uh, yeah, again, makes sense. COVID really wreaked havoc on this industry. R&D for its part, however, has remained steady, still below industry average, but it has remained steady. Now, considering the sector of the market that's constantly operating, it might not make sense, obviously, to spend too much on R&D considering the low margins. So, I'm looking for stability, underperformance, it's all right, you can live. Doesn't mean that Onsemi is losing its innovative edge. It just means the nature of the business does not allow it to spend as much as, you know, the industry average. So furthermore, the decline in revenue just highlights the tough operating environment. and further goes a long way in explaining that the fact that your margins have been very, very, very poor. All right, so net income, however, has increased by 57%. Even though revenue decreased, but all of that growth was just basically driven by the fact that on the real cost decreased. That is just the realization of decreasing costs. Return on equity, again, poor, but expected considering the margins have been poor. There's been virtually no growth. We've actually been losing revenue. So that that makes sense. I mean, it is poor though. It is poor. So as an investor, this shows you that Amazon is really struggling in achieving returns on capital invested. That ability has actually been declined. Okay, quickly to the financial position. The current ratio is deteriorated over the past 3-year period. It has rebounded though in 2020, from 2019 to 2020. It has rebounded. It has, however, underperformed the industry average, which is about 2.37. It's about 2.37. Still above 1, very close to 2. It does, at this level, even though you've underperformed the industry average, it does show me that Onsemi does still have enough liquidity on its balance sheet, still has enough short-term assets to cover short-term liability. The asset is same with the current ratio. It's underperformed the industry average, but at this level, it's not that bad. You know, it does show that Onsemi does still have enough liquidity. So pleasing. Actually, both ratios they are pleasing. Um, both ratios, the current as well as the asset test, on top of them being pleasing, they do not indicate any significant risk in liquidity. The inventory, however, worries me a bit considering the industry average is just over 101 days and on-segment average holds stock for 126 days. So it is worrying, but again, when you consider the fact there has been supply chain disruption, you're not selling inventory as fast as you would like. Stock is having to be held longer for the industry for far longer than it has to be, and this, of course, ultimately, it will eat into margin. Especially that will eat into net income because of the fact that you're spending a bit more on holding the stock, so there's an increase in holding cost. However, say might not have a choice considering supply chain disruption. Might not sell what it needs to sell because it might not get enough ships, it might not logistical support to ship and deliver semis to the required destination. Does not indicate a significant risk. When I look at the as a dollar value, considering the fact that the asset test ratio is basically current ratio minus inventory. So basically, so this is the current ratio less inventory, the asset test ratio. So without inventory, it holds 1.15 um, current assets or liquid assets. 1.15 times liquid assets when compared to liabilities. It holds 1.15 liquid times 1.15 times more liquid assets than liability. Whew, that took a long time to get out of my mouth. Overall, it is good, but I am a bit worried considering, there's a bit of a massive drop point when you look at it. With inventory, it's at 1.9, so almost 2. Without inventory, it's at just over 1.15. So it does show me that Onsemi does hold a significant amount of stock in dollar terms, which is worrying because that again plays on the increase in liquidity. It makes the balance sheet very, very risky from a liquidity point of view. Read together with the fact that gold stock for far longer than it needs to. and make the balance sheet quite liquid from my mind, quite um, risky from a liquidity point of view. It does have enough liquidity at the end of the day, but you know, from my point of view, it does not have the liquidity that I would like it to have for me to invest in. That's just the analysis of the current ratio, asset ratio that you need these days. Debt to equity at an average of 146% is above the industry average of 126%. I don't like it. It's above the industry. The debt to equity is above the industry average. Debt to equity at this rate indicates that the balance sheet is significantly geared, it's highly geared. There is a massive increase in financial risk. So, I mean, the debt to equity just makes the balance sheet for me too risky and unattractive. Read together with my liquidity ratio, it just turns me off this stock. The cash position, massive deterioration. There was a bounce back, however, in 2020. You can live with that. The margins are below the industry average of 32%. Decline to a large degree, again. So the decline to a large degree can be, of course, be blamed on COVID. However, there was a mass pop in 2020. I mean, look, it does indicate that honestly, this business model can generate cash. It can on average generate 17% of cash from all revenue generated, which is a good sign, but below industry average, decreasing. I don't like it. Now, the sufficiency of cash flow to a large degree is driven by debt repayments. You will see there has been a bit of a deterioration, but a lot of it is, of course, paying back the massive amounts of debt that constantly holds on his balance sheet. Um, Now, debt payments do make up a large part of the deterioration in the sufficiency of cash flow. It does make up a large chunk of cash being paid. It does well eat up a large part of cash generated. And the fact that margins have declined has not done this ratio any good. At 0.56 below the industry average of 1, also of 0.84. So my cash margins, both of them below industry average, have been declining. Slight improvement here and there, but the decline to me, even though it is understandable, I'm gonna stay away from this stock. It just creates a heightened risk for me. So the PE very expensive. Industry average is sitting at what? Just over 40%, just over 40, and your PE ratio is 107, just over 107. So too much of an expensive stock considering the performance. So for me, on semi, nah. I mean, look again. This will be investor dependent. It's an underperforming stock. I could use my cash productively elsewhere and return better, um, better returns actually elsewhere. TSMC, so Taiwan Semi for sure. Taiwan Semi is the longer, but TSMC, better known as Taiwan Semi. Now, this company, they actually manufacture the semis for semi companies. So they are the foundries that actually make the semis. Okay, let's get started with TSMC. Net income margins are very solid, have been improving drastically year on year. It's very impressive. It's above its newest competitor, Intel at 33%. Very, very satisfying. Growth in costs are very minimal. Um, it explains the out of this world margins basically. You're growing margins at an explosive rate, but not really spending that much. Now we're gonna get to why it doesn't need to spend that much. Now TSMC, Taiwan Semi, basically it's an accidental monopoly. You know, considering that 90 or so percent of the most advanced chips. Uh, TSMC is probably responsible for that. It it owns around about 57% of the semiconductor market. So I mean, you just imagine that 57% of all chips are made by Taiwan. So it's an active monopoly. It basically operates in a league of its own. So what I want to show you is that it does not need to spend all that much to prove its market or fight off competitors. Virtually, there are competitors, but not close. They're really, really, really not close. So whatever rate it spends at, that is sufficient, that is appropriate, that is more than enough, because that is what the market demands of. Now, furthermore, the strong margins are evidenced by low spending on R&D. If you look at R&D as a percentage of revenue, one might think, whoa, that's a red flag. No, not really, considering, yes, the industry average is about 20%, and Taiwan is the industry average is what? About 20%. I think Intel's on about spending 20%. But it's not worrying, because you have to understand Taiwan Semi, to a very large degree, has been investing way before. So right now it's realizing the expenditure in R&D that it did way back, probably half a dozen years ago. So it's basically now realizing that expenditure. So now it doesn't need to spend that much because it's in a league of its own. Nobody's close enough, and its customers are happy. Because customers are happy because I mean, look at the rate sales is increasing. Look at the rate income. If you look at the margin, it's still dominant in its market position. So it does not need to spend above what it already considers as fair because we're in a dominant position. It does not need to spend what it already considers as fair or what it's spending right now because it's already growing margins, growing its market share, and it's improving its level of customer quality. A lot of customers, so a lot of semi manufacturers are more than happy with Taiwan Semi. So now this spending, as conservative as it is, it reflects the market rate. All right, it is the market rate basically. So Taiwan needs to grow cost, improve quality, maintain dominant position. Yes, it does. However, this is all it needs to spend. So all costs are justified considering that Taiwan Semi is growing revenue at a compound rate of 14%, whereas Intel is only growing at 8%. The spending, like I said, conservative as it is reflective of the market. This is the rate that Taiwan Semi needs to spend or to grow costs at to improve and maintain its dominant market position. And it works. It is improving its market position, it's growing sales, growing margins, and it is improving it's improving its market condition as nobody's near. It does have competitors, but they're basically trading. So all costs are justified. We talked about that. Now the net income growth is significantly supported by the strong margins, excellent cost control, and hypersonic growth. Yeah, it is excellent margins, tight cost control. It doesn't need to spend what it does not need to spend on. It does not need to spend more than this considering this is there. And hypersonic growth in revenue. So the ROE is fantastic. There aren't any good words in the dictionary to describe how fantastic this is. Considering that the S&P 500 over the what is it 2018 to 2020 year returned about 16%. Taiwan Semi over the same period returned 27%. So this is more than good. This is out of this world. So Taiwan Semi obtained returns on capital invested on operations twice, 2 times more than the S&P 500. So that's very good. So profitability of Taiwan Semi, it's mainly driven by the dominant market position. As uh, every semi company that needs wholesale production of advanced semis basically makes the Taiwan Semi. the who's of the same industry makes use of Taiwan Semi. Now the financial position, you will see that there has been a decrease, uh, but it has still performed better than Intel's nearest competitor. Intel averages about 1.68 in terms of the current ratio. Taiwan Semi is at 1.92. So outperformed the nearest competitor. The same with the asset test. Intel had a asset test ratio of about 1.29. Taiwan Semi has an average um, asset test ratio of about 1.71. So it significantly outperformed its nearest competitor. The asset test, yeah, it has depreciated slightly in 2019, but has rebounded significantly in 2020. So even though there has been a decline, understandable because it's been using cash to fund operations, fund growth, as well as protect its market share. However, this decline is not a heightened increase of liquidity risk. Taiwan is in a strong liquid position. It still has more than enough current assets to settle current liabilities, more than enough liquid current assets to settle current liabilities, in a very strong liquid position, and it's outperforming its nearest competitor. That's very good. The liquidity position of Taiwan Semi is very strong. The inventory days, the inventory days just support the strong market position of Taiwan Semi. I mean, it paints a picture of a company that cannot make semis fast enough. Intel's inventory days is at 98. It's just over 98 days. Taiwan Semi average is at 67. So the performance is far greater than its nearest competitor. It just paints a picture. I mean, just looking at it, it just paints a picture of a company that really does not carry that much stock, and that will be supported by the current to asset test. Because when you look at the current ratio at 1.73, excluding inventory asset test, it's at 1.53. So it just shows you that as a dollar amount, inventory is not a large part of the balance sheet of Taiwan because it doesn't hold that much inventory. So I mean, the good performance, the fantastic performance. So very low inventory risk, because on average Taiwan Semi only holds stock for like 2 months. So that's doesn't hold stock for that long. So low carrying cost as well as low risk of the inventory being obsolete. So very good asset management there from Taiwan Semi. The debt to equity ratio has increased, to 26, 40 to 50%, but it's still far below that of Intel. Intel on average has a debt to equity of 79%. So even though it's increased, Taiwan Semi still has a debt to equity far below the industry average, far below the industry average. So it still has enough room to add debt without significantly burdening the balance sheet with risk. Uh, and of course, there's been a productive use of debt. When you look at the debt risk to return ROE relationship, as debt has increased, ROE has increased. So this just shows you that Taiwan is very efficient, very efficient in utilizing capital and achieving returns on um, invested in operation. So in any investment that Taiwan makes, any capital used to invest in investments does realize an above market return, and it's been very efficient with the use of its debt. Very good, very good, very productive with the use of its debt. All right, so cash margins are just ridiculous. They're ridiculous. They are really ridiculous. They're just ridiculous. I mean, just stand for a second and admire what you see right now. This is just beyond good. It's beyond great. This is out of this world good. Um, Above, obviously, Intel. Intel was sitting at about Intel. Its average is about 44%. Taiwan is at 58%. So, good business model, a business model that indicates to one that Taiwan Semi can convert revenue into cash. 61% of all revenue generated can be converted to cash. That is fantastic. That is out of this world. So increasing hypersonic margins that are above the market. This is fantastic. I mean, this gets a big tick mark for me. Now, the margin, yeah, it's beyond perfect. The sufficiency of cash flow. Intel's sufficiency of cash flow is on average 0.86. Taiwan Semi's average is 0.92. So above the industry average, has declined significantly. It has improved significantly actually. Declined slightly in 2019, but improved significantly in 2020. So there has been a significant improvement, bearing in mind that entities in the semiconductor industry tend to keep a sufficient cash flow below one. The fact that Taiwan Semi has it above one, and on average is outperforming the industry, is again nothing short of perfect. It's pleasing. It's beyond pleasing. It's a tick mark, 100% or 100%. It's a tick mark in every single metric. This company is beyond perfect. Pays a decent amount in dividends. It pays dividends at 37%, a good return in my view. Its PE is at 34. Intel's P is about just over 10, around about 11. Um, yeah, I mean, in my view, that's a cheap PE. Considering what you're getting a company that overperforms its nearest competitor in each and every single metric. A company that is virtually a dominant, unchallenged, accidental monopoly, by the way, that that accounts for what 56, 57% of all um, chips made are basically made by Taiwan Semi. It has a dominant market position, outperforms its competitors, strong margins, strong financial performance, healthy liquidity and balance sheet, significant cash generating ability, and gives a return. And sitting at 34, I mean, that is just pretty low. That is very, very low. Now, Taiwan Semi, in my view, is operating at a massive discount. Um, it, it should be trading at least 40% higher than what it is, and you can see that with the P of just 34. But that's because of China. The fact that there's a threat that China might take Taiwan, which is the country that Taiwan Semi operates in. The fact that there's a risk that China might take the country by force, you know, that uncertainty, that political risk, basically has discounted Taiwan share price for quite some time. So, I mean, it should be trading higher than this. It's a very, very good company. Qualcomm. Qualcomm is a developer and supplier of semis and system software that is used predominantly in the wireless and communication technology. Wireless and communication technology. Very diversified. I mean, it releases IP and software that creates a platform to design semis and other consumer tech. Nice. Financial performance. So the net income margin, very impressive. Decrease in 2020, but as you can see, there was a dramatic rebound in 2021. The net income margin is above the industry average. Industry average is about 18%, so it's outperformed the industry average. The performance of the cost, yeah, it's one that one can live with. You can live with it. Costs have not increased at a rate that threatens profitability, as evidenced by the margins. Cost growth is justified because it has resulted in growth in both the top and bottom line. So there has been an explosion in costs, but there's also been an explosion in my revenue as well as my net income and my margin. So cost is justified. Costs are resulting in a return both the top and the bottom line, which is driving very healthy competitive margins, having profitability. So R&D as a percentage of rev is fairly stable, above industry average, which again one can live with because you do not want to fall behind competitors. So it's fairly stable, it's above industry average. There has been a growth in my top and bottom line. Margins are stable and growing, so that's a tick mark for me. Now, growth in revenues are driven in part due to the boom in semi demand as well as consumer electronics. Uh, So the fact that again Qualcomm has basically been opportunistic and has pounced on that demand and has turned that demand into increase in revenue just highlights the strong performance of this company. Now, growth in revenue went a long way in improving. 7 decrease of 3. Now it's at 43%. So it's going a long way in terms of improvement. So margins have, growth in revenue and margin as well have really improved. Now, growth in net income just indicates a company that is highly profitable, growing its market share, and this growth in net income again just supports my margin. In growing net income, a slight decrease. Well, not slight. I mean, there's a massive decrease there, but as you can see, it really threatens my margins, considering the fact that I grew net income and my margin. So, I mean, good performance overall. Good performance indicates a very profitable company. Now, the financial position, current ratio, below industry average of about 2.37. However, it's not too concerning considering that on average, Qualcomm holds almost two current assets per current liability. So current assets exceed current liabilities by a factor of 2. Very good. Has depreciated over a 3-year period, but still has remained satisfactory. It's below industry average, but it's still enough. Asset test ratio, same, as the current ratio. Below industry average, the industry average of the asset test ratio is at 1.88. You can see Qualcomm is at 1.66. So underperformed the industry average, depreciated a bit, but it's still not at a point that highlights an increase in liquidity risk. Both ratios are still at a level that one can consider, what this balance sheet is significantly liquid. So Qualcomm has in 2021, it has 1.4 times liquid assets than it does current liabilities. So it can settle current liabilities as and when they do. So okay, good. So both the current and the asset test ratio, they do not highlight any significant increase in liquidity, even though both metrics have underperformed the industry average. The balance sheet is still significantly liquid, driven, of course, mainly by the $7.1 billion in cash. It has a lot of cash. The inventory days at an average of 81, 50, so just over 81 days is below the industry average of 101 days, which is very good. And the inventory days does support the liquidity. When you read it together with the current and asset test ratio, Qualcomm does have enough liquid assets on hand to settle current liabilities. So, but back to the back to the inventory ratio, the inventory days. So Qualcomm does not hold inventory for much longer than needed, considering the industry average is just over 101 days, 101 days, and Qualcomm on average holds stock for just over 81 days. So it's good performance. It's a good sign of asset management. Don't hold inventory for longer than needed. Improving your liquidity, improving your liquidity. So a lot of your liquid assets a lot of your short-term assets are tied up in liquid. that can be generally converted to cash. So it's a good sign. There isn't any burden on the balance sheet in terms of liquidity. There isn't any burden on your margins. So there isn't an increase in holding costs. So that is very good. Um, Debt to equity is by far, my goodness, by far above the industry average. The industry average is about 126%. Debt to equity on average is sitting at 457%. That is a lot. That is a lot. Um, you know what? Just back to the ROE. You know, look, the ROE. I mean, the ROE is a bit insane. The ROE of Qualcomm is a bit insane, but it's very good. You know, it has overperformed the industry. The industry average for ROE is 20%. On average, Qualcomm is at 117%. So this is very good. But again, it can be explained by good margins, strong revenue growth. So a good return on ROE, meaning that Qualcomm achieves above market returns on capital invested. Debt to equity, like I said, it's above the industry average. Now, this indicates a heightened financial risk on the balance sheet. It burdens the financial sheet with a lot of financial risk, even though there is a productive relationship between debt being risk and return being the ROI. As the ROI has been increasing, as the debt to equity has been increasing, ROI has return on equity has also been increasing. There's also been a decrease, but there is a positive relationship in the fact that above industry debt to equity, above industry return on equity. But even though there is a productive relationship between debt and return on equity, the financial risk for me is just too high. I mean, that just adds a significant amount of financial risk on the balance sheet. Okay, so the cash margin is very impressive, slightly below the industry average of 32%, but has been increasing. It has been improving yearly, and this margin indicates to me a company that can generate cash from its operation. So it's good. It's below industry average, but I can live with it. It is good. You know, Qualcomm has cash positive operation. The sufficiency of cash flow very impressive, above the industry average. You know, industry average is about 0.84 and Qualcomm is at 0.92, so it's above industry average. That is very good. And in 2021, it achieved an above one sufficiency of cash flow. Considering the amount of debt it has, you know, it does have enough. It does generate enough cash from operations to settle debt, which is good. Which is very, very, very good. Okay, so total shareholders return, so this will include dividends and buybacks, above the industry norm. Industry norm is about 46%, and Qualcomm is 21 and average 23%. So it's above industry average. So shareholders are definitely getting rewarded, in my view. You know, it is, however, a very cheap stock, considering the fact that the average PE is what? Just over 40 and Qualcomm is just over 20. So it's a relatively cheap stock. Um, However, too risky for me. Even though yes, it does generate enough cash from operations to settle the debt, too risky. That's way too much financial risk. Too much debt. Intel. So Intel develops a broad range of semis, gaming, storage, connectivity, as well as semis used for autonomous systems, as well as a foundry business that manufactures semis for other semi companies, same as Taiwan Semi. However, the business of Intel, the foundry business, has been absolutely decimated by Taiwan semi. And it also provides software needed to make semi. Okay, let's get into Intel. The net income margin has performed well, relatively stable. It's above the industry average of about 80%. Okay, just one more thing about Intel. Intel, Taiwan Semi just manufactures semi. It is a pure foundry. It just makes the semis for uh, other semi companies. Intel not only so Taiwan Semi does not develop semis. It just makes Intel, in addition to making the semis, it also designs and develops. So it has another arm of its business that Taiwan Semi does. So Intel competes on a wide range, whereas Taiwan Semi is specifically specialized in just making semis, foundry business. Intel is a foundry business, but also designs and develops its own semis. Just wanted you to have that bit of background. You will see what's important as we go through the analysis. Okay, so we talked about the stability of the net income margin, the fact that it is above the industry average. Now the margin, their good performance can to a degree be basically explained by good cost control. You look at the cost of revenue. You look at the cost of revenue as well as the cost of revenue. Yes, it has popped from 2019, but still, you know, basically it's reached 2018 levels. So pretty much stable expenditure there. R&D is not really increasing R&D by that much. So very, 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 very tight cost control. Costs are being kept on a leash, and that has resulted in pretty stable margins. So stable costs will obviously result in stable margins. So revenues, however, are not really growing at an explosive rate. They are, however, in line with industry average. Industry average is about 6%, so growing on average in line with industry average, but not much to really write home about. So you understand why costs are kept on a tight leash just to protect profitability. So R&D as a percentage of revenue is very stable at an average of about 18%, slightly below the industry average, about 20%. However, in my view, I feel like this should be a bit higher, considering that Intel has lost ground in many of its competitors, not just Taiwan Semi, but also other developers and designers of Semi. Just lost ground on all sides. It's a company that is under siege, so I would expect it to really be aggressive in growing R&D. Okay, so now growth in revs, like we said, really lackluster. Not much to write home about there. Revenue growth, then not necessarily mediocre, just not what you would expect considering the market is growing at such a fast pace and the business and the assets that Intel has. You'd expect revenue to be a good high in years. I mean, it's in line with industry average. I mean, that's decent, but you'd expect more considering what Intel is, and where it should be. But anyway, so so revs, they're not necessarily mediocre. They're just really uninspiring, and that uninspiring revenue growth can basically be explained by Intel's strategic blunders in the fact that it didn't pursue certain markets. For example, producing semis for mobile phones. It didn't aggressively pursue it. It wasn't really productive in developing next gen semis. It just made a lot of strategic blunders. The net income growth, again, lackluster. Nothing really to write home about. Lackluster, but it does follow very uninspiring. The ROE, however, is above the industry average, about 26%. So the return on equity on average about 31%, above industry average of 26%. But this is understandable, as you know, Intel is a well-run company. It just lost its strategic vision, about half a decade to half a dozen years ago. So, looking at, the margins, looking at these matrices. So from a financial point of view, Intel is a very solidly well-run company. It is. The problem with it is a strategic vision. It has allowed competitors basically to gain and steal market share from all business segments, as you can see by the really lackluster performance. But it is a well-run company. Just lost the strategic edge. The financial position, however, current ratio below the industry average, 2.37. However, looking at the level it is at, there's no heightened increase in short-term liquidity risk. Intel does have enough short-term liquidity on its balance sheet. The asset test, same as with the current ratio, below the industry average, which average for capital is about 1.88. But looking at its level again doesn't indicate the heightened increase in liquidity risk. So even though there has been underperformance in the asset test and the current ratio, Intel is still in a good solid liquid position. Short-term assets as well as liquid assets are enough to cover current liability. Good thing about Intel is that it has well over 5.8 billion in cash, so in a pretty decent, liquidity point of view. The inventory days have, however, outperformed the industry average. At an average of just over 98 days, the industry average is 101 days, so it's very impressive. So it's very impressive, and it goes on, highlighting the fact that Intel is still in a good liquid position. Doesn't hold stock, doesn't hold inventory for longer than it needs to, especially when compared to the industry average. So that's very good. So it doesn't have the balance sheet is not burdened by illiquid assets, which are inventory, doesn't hold inventory for that long. As well as margins aren't burdened by increase in holding costs. Because the more stock you hold, the more holding costs you're probably going to have to incur. So good asset management, all this good asset management just basically highlights a decently liquid financial statement, a decently liquid balance sheet. The debt to equity is very respectable. At 79% on average, it's below the industry average of 126%, which is good. It indicates that Intel still has a lot of additional room to add debt without really wrecking the balance sheet and adding too much risk. So it does have a low debt level, makes it very risky, makes it very less risky and very attractive, as well as it will need this attractive balance sheet. Basically, just start clawing back some much lost market share. Alright, so the cash position. The cash margin, again, very impressive at an average of 44% above the industry average of 32%. And again, it's very stable, good indicator of a mature business model, as well as an entity in Intel that can generate revenue from its operations. I mean, in 2020, 45% of its revenue turned into cash. So that is very good. That is really, really, really good. Sufficient of cash flow, fairly stable. A lot of cash. Does ever go into the return share? Goes into returns to shareholders. It is slightly above the industry average. What is sufficient cash flow? So sufficient cash flow is 0.86. That's on average, and the industry average is 0.84. So it's slightly above industry average. Good performer. a decent performance. It's also a very good indicator that Intel is in a strong cash flow position with enough cash generated from operations to fund all necessary operations. Now, since a lot of available cash goes to shareholders, an indication that Intel makes use of cash to reward shareholders and being effective with cash and just holding it on the bank, so they burn holes in the balance sheet. Now, the industry average of return to shareholders is around about 46%. Intel's average is 56%. So even though, even if Intel can cut its, its returns to shareholders, I mean, the stock will get hammered, it will get punished. But even if it can cut that, just to boost its available cash on hand, just to boost the face of cash. I mean, sufficient cash flow is still very good. It's still decent. It's outperforming the market. But Intel has lost so much market share that it needs a very, 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 very large war chest to go out and close that. But it's not going to be easy. Really not going to be easy. So, you know, it's good. I mean, look, the return is good. The, the margins are good. The sufficient cash flow is very good. Returns are excellent. But, you know, you get a feeling something must give with Intel. I mean, its PE is at 9, which is just laughable. For me, Intel, I mean, it's a well-run company. Problem is, the strategic vision just let it down a bit. And I think once Intel can just get a hold of the strategic vision, just basically reinvent itself, I would stay away from it. I really would because um, projections do indicate that Intel is really going to struggle in growing back market share. It's behind almost each and every single competitor. So it still has a long way to go. But you know, for me, nah. Right, Micron. So looking at Micron is a manufacturer of memory and storage. Then looking at its financial performance, the net income margin has deteriorated significantly. However, it saw a massive rebound in 2021, above the industry average of 18% on average. The net income margin is what? 32%, and the industry average is 18%. So that's good. But the margin deterioration, um, which there was mainly due to COVID. But you must remember that even though there was a massive deterioration, there was also a massive rebound. However, competition in this sector of the industry is also very fierce. So heavy competition is also weighing down a bit on margins. Thus, even though margins have rebounded, we need to give a closer look at other measures. To see how effective Macron has been in not only confronting competition and reducing the effects of COVID. Now, the effects of COVID, how much it reduced it as logically possible. COVID has really ran a riot over operations, but you have to see how productive effect. So, however, in the face of tough competition and COVID, cost control has been very, 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 very tight. Been very, very good actually. Reining in costs to protect margins as well as basically reduce prices to try and claw away some market share. So cost control has been good. When you look at the fact that the performance of the cost of revenue is slightly above the industry average of just 9%, at 12%, is slightly above the industry average. However, so slightly below, so slightly above it, huh? This is a good indication of trying to reduce costs, just reduce the effects of COVID, as well as to improve the competitive position of Micron. R&D, however, is below the industry average. So Micron has increased R&D at a rate below the industry average. I mean, this just highlights the fact that Micron has been almost obsessed to a large degree in just getting costs under control. So it's shown decent cost control, not only protecting margins, but also to ensure that the costs that were incurred do result in a return. And when we look at our top and bottom line, we can see that, yeah, the costs have resulted in a return, as you know, looking at how much we've increased revenue, looking at how much we've increased net income as well. So yeah, costs have been justified in providing a return. Spending on R&D, however, in my view, seems to be a bit insufficient. I mean, at industry average is about what, 20%, and Micron is only investing 11% of revenue in R&D. Worries me a bit. You know, it, it appears to be insignificant from my point of view. Um, it does not. You know, it appears to be a bit insignificant. ROE below industry average of about 26%. However, not gonna cry too much about it because you know the ROE figures, you know, especially if there's a decline, but that can be explained by COVID, massive rebound, response to COVID. The rebounds mainly due to response to COVID, getting costs under control, being effective in using operations to provide a return in the form of sales and growing the bottom line, stable margins. So it's good. It shows me that Micron does achieve a return on capital investment. I can live with that. Below industry average, but I can live with that. I can more than live with that. The financial position. So the current ratio sees the industry average. Industry average is about 2.37, and Micron's average is what? 2.8. And on top of that, the current ratio has been improving. So again, this highlights the very, very strong liquid position Micron is in. Asset test ratio supports the current ratio. So with the asset test ratio, we can see that Micron's liquid assets have been improving. You can see that improvement there, as well as it's at a level that's above the industry average, just over 2. Just over 2 is above the industry average of about 1.88. So both ratios are very impressive. They highlight a company in Micron that's in a very strong liquid position. The balance sheet is very liquid and has virtually zero to little liquidity risk. Very, very good. The inventory days, however, on average, they are above the industry average. Industry average is just over 101 days. Micron's inventory days are 124 days on average. However, what can be improving or what can be satisfying is that there's been an improvement. That improvement is satisfying. Um, so Micron has been improving its asset management. So I like that. So even though on average it's above uh, the industry average, not the end of the world. Since the inventory days have been significantly improving, there's been a dramatic improvement in liquidity. So the balance sheet overall has really, really, really been improving and is really, really, really in a strong, strong, strong liquidity position. Debt equity paints a picture of a company that, well, doesn't have sufficient, well, doesn't have significant financial risk. The industry average is about 126. Micron's average is about 35%. So very good. Look from a balance sheet point of view, solid solid liquidity, improving inventory days, so no little liquidity risk, virtually no financial risk. So company still has a lot of room available to add debt should it need to improve. So it's a very liquid, very low risk balance sheet that Macron has. Very impressive. Cash margin, well, it's deteriorated, but in 2021 you can see there's been a massive bump. Um, Deterioration of core, the deterioration, mm, not what is it? But, it's not worrying. I think that there was a massive rebound. I can live with that. There's been a massive rebound. Margins are of course above industry average. Industry average is about 32%. Macron average what 47%. So very good. Um, So Micron itself has outperformed the industry. The operations are healthy enough to convert revenue into cash. That's what this ratio tells me. You know, it has a business model that can generate cash basically. So a very good performance for Micron. You know, it has really high um, what is it, cash margin. I like that. The sufficiency of cash flow slightly below the industry average. Industry average is about 0.84, but has shown decent improvement after a slight deterioration in 2020. Very strong improvement in 2021. Again, this can be supported by the strong um, performance by the cash margin. One can live with that. So the sufficient cash flow is mainly burdened by investing activities. A lot of Macron's cash resources go towards investing. So, you know, they are investing, they are improving their operation, they are adding to their capacity. That is very good considering the kind of heavily competitive market is. You know, so Macron does not want to lose market share, using a lot of its cash to invest in its operations. I can live with that considering how strong the company has been performing, considering the strong balance sheet it has, considering the fantastic top and bottom line performances, the good cost control, good cost discipline. Yeah, I can live with that. So, you know, Marcon is a very good company. The buyback very low, due most to the fact of the mainly due to the fact that the entity's cash is mainly tied up in investment activities. So it doesn't pay that much, but you know, it's using available cash, you know, just to improve its market share, grow its market share, protect its market share, to add, you know, long-term shareholder value. So I can live with that. I like the cash performance of my fund. It's very good, very good. Yeah. So overall, I think yeah, Micron is a very good entity overall. I mean, there aren't a lot of bad things wrong with it. You know, it's really a good company. Really good company. I'm impressed with Macron. Well done, Macron. Okay, so now looking at what is next. Broadcom is next. Broadcom. So Broadcom designs, develops, and supplies a broad range of semiconductor and infrastructure software solutions. Uh, Due to the financial performance of Broadcom. Alright. Now the net income margin is below industry average of 8%. Not that impressive. Good news, however, is that the margins have doubled. Well, they've more than doubled over the 3-year period. They went through an average of about 10% for 2019-2020 to well over to about 25% for 2021. So that is good. That is pleasing. Good sign, you know, of a thriving business in the face of COVID as well as tough competition. Cost control is pleasing. It has contributed to growth in the net income margin. R&D as a percentage of revenue, it's pleasing to a degree. It is in line with industry average, so you really cannot complain about it. I mean, they're performing in line with competitors, with the rest of the industry norms. Okay, so not really that bad. So proper cost control has resulted in uh, a return on these costs. Because we look at the fact that they've reined in costs either increasing at a decreasing rate or flat out decreasing in the form of R&D growth. So they really reined in costs, and this reining in of costs, it has protected margins. We've seen margins have ballooned, but also look at that, a return in the form of growth in revenue. So that is a good sign right there. Now, if you consider the fact that proper cost control, it has contributed handsomely to the growth in, you know, not just the top but also the bottom line in my net income, which is very pleasing. So it has underperformed the industry in the form of the net income margin. But you look at proper cost control, has led to returns, it has protected margins, it has improved the bottom line of my net income. It is satisfying. With satisfying performances, R&D as a percent of revenue in line with industry average. So it's a, it's a pleasing performance, a decent performance. Now the ROE, the return on equity, below industry average, but has significantly improved from 2019. So that is the improvement as well. To me, it's pleasing. Now, the improvement is of course supported by solid growth in revenue, stable margins, and good cost control. So good financial performance overall by Broadcom. The financial position, current ratio below industry average. The industry average is 2.37, but the ratio has improved significantly over the 3-year period. Looking at what it was in 2019, 2020, and 2021, there's been a significant improvement. That is healthy. Asset test um, ratio slightly underperformed the industry average. Slightly, the industry average is about 1.88. Broadcom asset test is 1.82. So it's closer to its asset. It's closer to the asset test is closer to industry average. Not that far. There is underperformance, but it's really not that far. Now, the main catalyst for the significant improvement in the asset test as well as the current ratio is the explosion of cash on hand. I mean, Broadcom has over $12 billion in cash. A lot of it is due to the fact that it has increased its borrowing base. Both both ratios, in my view, underperformance, but they're pretty solid. Um, you look at the current ratio, Broadcom has well over 2 times the current assets to cover the current liabilities. Asset test, same thing, well over 2 times liquid assets to cover with the current liabilities. So overall, no strong financial position just looking at those two ratios. No liquidity risk in my view. Now the inventory days has overperformed the industry average. The industry average is just over 101 days. Broadcom's inventory days are on average 37. So massive overperformance. That is very good. That shows me that there is no risk of inventory being obsolete because Broadcom does not hold inventory for longer than what it has to. Strong margins in the form of my net income margin because what? The more you hold on for inventory, the more holding costs you're gonna have to spend. The more holding costs, that's gonna hit your bottom line. So there's no burden on my margins in the form of increasing holding costs, no form in the burden of the balance sheet in the form of liquidity, so holding on the stuff for way longer than you need to. So the inventory days ratio read with the current and asset test ratio show me a company that is in a strong liquid position. The balance sheet is very liquid. That is very good. The debt to equity, however, at a at an average of 197%, almost 200%. Is above the industry average is 126%. Now that shows me a heightened increase in financial risk. Yes, I understand there's a productive relationship between debt, risk, and returns being the ROE. Yes, there's a productive relationship between the two. You know, Broadcom on average has been quite productive in achieving returns on capital invested and has been productive in the use of its debt. However, at almost 200% on average, above the industry average of 126%, very risky. You know, very, very high debt levels that make me a bit nervous. Cash position, very good. Very, very good. At first glance, are very, very good. The cash margin, the cash from operations margin, has significantly improved and is overperforming the industry. The industry average for cash margin over the 3-year period is 32%. Broadcom is achieving 48%. So what this ratio tells me, on top of the overperformance, that is overperforming the industry average, which is very good, that it converts 50% of revenue into cash from operations. That is a very, very good number. That is just fantastic. Um, yeah, fantastic ratio. I'm happy with it. It is impressive. Shows me that Broadcom's business model can generate cash from its operation. Very good. The sufficiency of cash flow, however, slightly under, well, not slightly under, always disappointing. It has underperformed the industry average. The industry average is about 0.84. The average for Broadcom is 0.44. So it is very, very disappointing. Has been improving. However, this just paints a picture of a company that's, well, paying a lot of debt. You know, quite a lot of the cash flow goes into, well, repaying debt. Now, I'm not anti-debt, but I'm not anti-debt. It's just that I have a risk appetite with too much debt just turns me off a company. I mean, if you're recording this much debt, um, your financials have to be out of this world. I mean, they are good. Don't get me wrong. I mean, they are close to out of this world. Looking at the strength of the liquidity, looking at the increase in margins, top and bottom line growth. Good, but it needs to be out of this world. I mean, that to me is just too high. It's just I'm not against debt, but that's just too high because and you can see the effect of high debt on the sufficiency of cash flow because you could end up having a situation where you well run into trouble. Where you basically just run into trouble. Where you're investing way too much in repaying of debt and withholding not that much to pay for shareholders. I mean, in this case, they are paying a decent rate, but if you don't have enough cash, it's a bit of a worry considering how are you going to respond to competition. So, I mean, I'm not against debt. It's just high debt levels do make me nervous. Now, you can see with the increase in debt comes, well, the fact that you're basically going to underperform the industry in some metrics, especially the cash flow metrics. However, let's move on. Like I said, my risk appetite, I cannot stomach such high debt levels. All right, the dividend yield, like I said, it's pretty healthy, slightly below the industry average of 46, but very, very healthy. The P ratio is fairly decent, considering the industry average just over 40 and Broadcom's PE is just 38. So it's relatively a cheap company. However, yeah, for me, it has too much debt. I understand, with COVID and all of that, but it has way, way, way too much debt for my liking. Considering, it makes so much cash, I don't get why you need that much debt. But like I said, it will be investor dependent. For me, my risk appetite, that's just too much. But good company, good growth, top and bottom line, healthy margins, strong balance sheet. The financial risk just makes it a bit unattractive. All right. Applied material. The applied material provides software services and manufacturing equipment to the semi and display industry. So it's one of those companies that makes the equipment that's needed to build semi. Let's get to it. So the financial performance, the net income margin has been fairly stable, below industry average of 27%, only slightly though. And the net income margin performance is decent and not that far behind from the industry average. And the margin has been going from strength to strength. So growing margin, all right, I can live with that. Decent cost performance. Costs can be said that are justified. They're not growing at unsustainable rate. The cost that I mean, they're not really growing at unsustainable rate and are resulting in a return. So looking at how much they're spending on cost, it's not really depreciating margin. And this investment in cost, look at what it's doing. It's resulting in a return in the form of growth in my revenue as well as my net income supported by strong growing margin. Right? I can live with that. That's very good. R&D as a percentage of revenue in line with industry average. Industry average is about 13% and we're spending about 30%. So we can live with that. In line, decent. No complaints with that. Like I said, the entity is realizing a return on operational costs as operational costs are resulting in growth in revenue, with revenue growing at 34% and net income is growing at 53% just in 2021. So good performance overall. No one can be happy with that. The return on equity, even though it's below the industry average is about 53%. It has, however, been improving. Slight dip, very slight dip, but it has been overall improving over the past few years. So its performance does show that AM Applied Materials is a company that is very efficient in realizing returns on capital of equity. Right, good, easy, decent, satisfied. No complaints there. Financial position, current ratio has underperformed the industry average at 2.9, but still a decent ratio. The ratio does indicate that Applied Material does have significant current assets to cover current liabilities. So no heightened liquidity risk on the balance sheet. Same with the asset test ratio, underperformed the industry average. Industry average is about 2.17, uh, but it does have enough liquid assets on hand to cover current liabilities as and when they fall due. So the asset test ratio, same as the current ratio, they both underperform the industry, but at these levels do not highlight an increase in liquidity risk and highlight a pretty stable, a pretty decent liquidity position in AM's balance sheet. So not awful, but both ratios do indicate decent, strong enough liquidity position. Now the decline in the current ratio from 2020 to 2021 is mainly due to the decline in cash. Cash went from $5.3 billion to $4.9 billion in 2021. But again, nothing really to throw a hissy fit about. Still a liquid balance sheet. Inventory days have overperformed the industry average. Now, on average, the inventory days are about just over 160 days. AM, its average inventory days are 144 days. So it does not hold inventory for longer than the industry average. This is very good. good asset management, and just supports the stable and strong um, liquidity position highlighted by the asset class and the current ratio. So very good, very good. No liquidity risk from my point of view. The balance sheet is liquid enough. I like a liquid balance sheet. All right. Now the debt to equity below the industry average. Industry average is 171%. So the good indicator as AM is not highly leveraged. There isn't a heightened financial risk on the balance sheet. The balance sheet is pretty attractive. So the high debt levels do make sense. You kind of do it. It is normal in this industry to have high debt levels, but the most important thing is that AM does not have debt levels above the industry. The high debt levels are of course needed as um, revenue, is only received once, the equipment is shipped or has been substantially manufactured. As a result, you will get companies like will get to just plug a shortfall in cash flow. But again, not a heightened risk. Debt levels are normal in relation to the industry average. Now the cash position, the cash from operation margin. Below the industry average is about 26%, but only slightly, but has improved dramatically has improved decently from 2020 to 2021. There has, however, been an underperformance in relation to the industry. Yes, we do know that the industry is about 26%, it's only at 23%, but like I said, not too worried. It has been increasing, does indicate a company in applied materials that has operations that can convert revenue into cash. Strong business model, cash flow positive business model. The sufficiency of cash flow below the industry average, but only slightly. Industry average is about 0.66. Materials at 0.65. So only slightly below the industry average, very, very slightly. Um, the sufficiency of cash flow has been improving, supported by the strong cash margins. So decent, you know, um, very decent. No complaint from my side. The sufficiency of cash flow does indicate that Applied Materials can generate cash flow to fund operations at these levels. It is very good. A lot of cash, however, of Applied Materials does go into rewarding shareholders. Again, it's an efficient use of cash. If there isn't any businesses or any investments needed to be made in the operation, more of an efficient use of cash to just give it a reward to shareholders rather than hoarding it. The PE is slightly below the industry average. The industry average PE is just over 22, close to 23, and Applied Materials is sitting at about 21, just over 21. So it's a pretty cheap company. So overall, Applied Materials, you know, it has a very cheap PE. It's performing really, really well. I really, really, really like this company. The company that's performing in a very, very, very decent position. Texas Instruments is a designer and manufacturer of singles. Okay, let's get into the financial performance. The net income margin has been consistently strong and at more than double the industry average. The industry average is about 18%. The margin is of course supported by good cost control. Costs have really been reined in 2020. Costs have been declining, mainly due to the declining output and slowing revenue and net income. You can see revenue only increased by 1%, net income by 5%. So the declining cost is basically to save margins and save profitability. At the same time, that is a bit worrying, considering it might mean you're lagging behind your competitors. You know, could mean you're losing a bit of um, market share. So R&D as a percentage of revenue below the industry average. Industry average is about 20%, R&D is about 20%. Now this matrix is stable. R&D has been stable over the past 3 years, but it's a bit worrying considering Text Instrument is experiencing a bit of a slowdown in the top and bottom line of growth in revenue and growth in income. So you'd expect them to increase spending in R&D a bit, in order not to lose innovative ground to competitors. Growth in revenue, we talked about it. It's pretty mediocre, below the industry average. Industry average is about 8%. The average over the past 2 years for this instrument is about -1%. Now, this lackluster growth, does indicate a few things. Number one, the loss in market share, the impact of COVID, which just made things worse. But revenues have been slowing down even pre-COVID. So, but it is a bit worrying. It is a bit worrying. However, profitability has been protected, but the slowdown in revenue and net income is a bit worrying. But return on equity is far above the industry average. Industry average is about 26%. The average for this instrument is 8%. So very good, highlighting efficient use of equity to achieve returns on operations. So very, very good. Now ultimately the performance of this instrument is decent. This instrument has a solid, above average margin, but the margins they remain good, mainly due to proper cost control as well as reduction in spending rather than growth in revenue. But Texas Instruments is a well-run company. I mean, it's achieving massive returns on equity. It's a good company, but that just worries me. It really does. Okay, the financial position, current ratio, incredibly good. Way above the industry average of 2.37, indicates a very liquid, less risky balance sheet. Asset test ratio, also way above industry average. Industry average is about 1.88. It's a very pleasing indicator. Again, highlights the entity is very liquid with little liquidity risk. So both indicators highlight a very attractive balance sheet full of liquidity. Both ratios have been improving, indicating the instrument's liquidity has been growing from strength to strength. Now the good liquidity can also be supported by the over $3.1 billion in cash. Inventory days. They've underperformed the industry average of 101 days. Bad sign, but considering other liquidity measures, not too worrying. So considering other liquidity measures, they do paint a strong balance sheet, even though the inventory days are below the industry average. It's not an additional liquidity risk. Texas Instrument might hold inventory, well, it does hold inventory for far too long than the industry average, far too long than it should. But the overall liquidity risk is low, and considering that the costs have been decreased, it does not appear that holding on this inventory is really eating into margin. So the debt to equity is well below the industry average of around 26%. So Texas Instruments is not highly geared when compared to the industry. Does not have increased or considerable amount of increased financial risk. So overall, a good balance sheet. Cash position. The cash margin is very good. It's above the industry average of 32%. So very good. Now, It has decreased slightly in 2020, but it still outperformed the industry by quite a lot. So the cash from operations margin shows me an entity that can convert its operations into cash and that can generate cash from its operations and that can convert revenue into cash. So so 42% in 2020 of revenue is converted into cash. Very, very good. Not bad. Now, the sufficient cash flow margin is in line with the industry average of 0.84, so it's performing in line with its peers. Now, most of the cash that Texas Instruments generates goes into paying dividends. The dividend yield is way above the market returns or the average industry returns about 46%, way above it. It's paying, it's providing shareholders with above industry average shareholder returns. It is good considering it does generate way above industry average cash margin. Very, very good. However, you know, declining revenue a bit worrying to me. And just shows me a company that's losing market share. The PE, the price to earnings ratio, very cheap. Considering the industry average is just above 40, trading at almost 28. Very cheap, but there's a reason for that cheapness. Falling behind its competitors a bit, giving me good, giving me, it is achieving good ROEs. It has a strong, stable balance sheet, strong margins, but one questions why it needs to spend 97% um, of its available cash in the form of dividends when we can probably half that and spend in line with industry average and do something about these really poor top and bottom line numbers. Do something about losing market share. So overall, Texas Instruments, it's a good company, but not for me considering there's too much competition risk that this company faces. NVIDIA. NVIDIA provides high-performing GPUs and system on a chip platform. A system on a chip platform is basically um, it uses its software as a platform to help clients design custom chips. That's basically what it is. Full disclosure, I own NVIDIA. Um, we'll get more into my ownership of it later on, but I own it. Good performing stock, but we'll get into detail with that later on. So financial performance. The net income margins have been deteriorating, however, still above the industry average of 18%. The deterioration is caused by an increase in costs, especially R&D. R&D has really, the growth R&D has really exploded. Cost of growth have been growing above the 9% industry average. The same is true for R&D, which has also been growing above the industry average of 10%. And that all explains why the margins have been declining a bit. R&D as a percentage of revenue is well above the industry average of about 20%. All right. Now the increase in cost, it's hard to justify against it because it is a necessity. And if you look at the fact that the increase in cost, yes, they deteriorated my margins a bit. However, look at my growth. That can be explained by COVID. Look at that. Look at that bounce back. That is a lot of market share that you're getting, a lot of market share that you are retaining. So you're growing So revenues are growing at about 53%, on average 22% for the 3-year period 2019, 2020, 2021, well above the industry average of 8%. So the costs, yes, they've deteriorated my margins slightly. However, they're resulting in a return in the form of growth in revenue, growth in market share, as well as retention of market share. Net income has been growing at a compound rate of 16% over the past 3 years. So again, it's hard to argue against these costs. These costs are justified in providing returns in the form of growth in net income as well as growth in revenue. Furthermore, it is important to note that in the GPU market, Nvidia is basically untapped. They are competitors, but really dominate that market, especially with regards to gaming. So Nvidia is in a strong, aggressively dominant market position, and all other competitors are basically, they are playing catch up. Such spending is not excessive, but rather essential to Nvidia's continued dominance. Now, above industry growth in costs, above industry growth in um, revenue, and above industry investment in R&D, above industry returns in the form of growth in revenue. So good company, costs are justified, costs are resulting in a return. Now the ROE, above the industry average is about 26%, so it's a good indicator that Nvidia is achieving above market returns on equity invested in operations. Perfect. Financial position. Current ratio is very impressive. It's beyond impressive. It's as close to perfect as perfect you can get. The industry average is 2.37. Nvidia's average in current ratio is 6.57. So very good. As a test, same with the current ratio, it is highly impressive. Considering the industry average is 1.88, and look at the average for the asset test. Basically more than double. So very good performance. So very low risk, making the balance sheet very, very attractive. So very low liquidity risk, making that balance sheet very, very, very attractive. Now, both the current ratio and asset test ratio, yeah, they have declined quite dramatically. But even with the decline, the performance is still above the industry average, driven by the more than $11.5 billion in cash and cash equivalents as well as market securities. So Nvidia has a lot of cash on its balance sheet, a lot of cash. Again, that just highlights its strong liquidity, so the strong liquidity position its balance sheet finds itself in. And remember, it's important to note that the decline, mainly in part is due to the fact that short-term debt has increased. So the decline in the asset as well as the current ratio, the decline is with increase in short-term debt. Not a worrying factor, not something to throw hissy fit about it. It is expected. These are growing pains. Nvidia is using a lot of its cash to fund its growth, to improve its operations. So not really something. So this decline, not something to cry about, considering it's well above industry average and it is solid and does not indicate any heightened increase in liquidity risk. So very, very good. Inventory days have underperformed the industry average. Industry average is just over 101 days. Nvidia's average inventory days are sitting at just over 106. Alright, so there is an underperformance, but however, the inventory days, when you look at the inventory days, when you look at the asset test ratio and the current ratio, it really does not indicate the company that is heading into liquidity ruin. Even though inventory days are above industry average, just slightly, it has not derailed the liquidity of this company. The liquidity of Nvidia's balance sheet is incredibly attractive. Alright. So even though Nvidia does hold inventory for longer than the industry average, This has really not derailed the liquidity of the balance sheet. Still, there's no increased risk on the balance sheet. The balance sheet is still fairly liquid. Debt to equity ratio has increased, but considering that the industry average is 126, it's still below the industry average. So the debt to equity ratio does not highlight significant increase in financial risk. Still a very attractive balance sheet. It still has enough room to grow to add debt without increasing financial risk. That 70%, industry average is 126%, so it still has a lot of room to run before it can even start to wreck the attractiveness of the balance sheet. The balance sheet very attractive, very liquid, not highly geared, very low risk balance sheet. Now the cash position, the cash margin has outperformed the industry average. Industry average 32%. Strong indication that Nvidia's operations can generate cash, and Nvidia is productive in generating cash. On average, it turns 36% of its revenue into cash. That's very good. There has been a deterioration, but there's no sign. Looking at everything, looking at my performance, looking at the returns it gets on capital, looking at the balance sheet, looking at my liquidity and financial risk, looking at all of that, looking at the cash from operations model, there is no indication for me that Nvidia is in decline. The sufficiency of cash flow has deteriorated, but still overperformed the industry average. Industry average is 0.84, and the average for Nvidia is at 2.45. So that is good. That is very good. Now, the sufficient of cash flow, even though there has been a deterioration looking at 2020 to 2021, that's being driven by acquisitions as well as improvement in operations through investment. So it's not, just losing money. It's not just losing money. It's actually using cash from operations to invest in operations to make them better and to add long-term shareholder value. So it's very efficient with its cash use. I like it. That is very pleasing. So the overall cash position of Nvidia is very positive. Now in 2019, um, that ratio is a bit abnormal, but that's because there was a buyback and a dividend yield. But normally Nvidia, but ever since then Nvidia has been issuing a dividend. Dividend yield is low. Now considering that Nvidia is in the ascendancy, we don't expect it to provide much shareholder returns. I expect it to reinvest a large part of cash generated from operations in said operations to improve long-term shareholder value. So I really don't expect it to pay what 10%. I mean, at 22%, it's way below the industry average of 46%. That wasn't an abnormality. So I expect it to keep its returns quite tight at these single digits because it's under sentencing and it's really trying to protect its market share and grow its market share and really be a dominant player. So I expect it to basically, instead of returning with cash to shareholders, I expect them to reinvest said cash in operation to grow the business further. At a P of 34, just over 34, it's well below the industry average of just over 40. So it makes it a very attractive company. Overall, Nvidia, very attractive company. Again, that just goes into that market correction that's been happening since the beginning of the year. But again, a very attractive company at a very cheap PE. Yeah, thumbs up for me from this company. I like it. ST Microelectronics. designs, and develops a broad range of products including semis and electrical devices. On net income margins pretty stable, okay, below the industry average of 18%. Now, ST Microelectronics does again operate in a fairly competitive market, uh, which has decent but not very high, margins. This sector of the market is not known for having really high margins. It operates in a very crowded space. So costs have been increasing at a slowing rate. In the case of cost of revenue, the growth of it, slightly above market, just slightly above market, has been increasing but slightly above market, but overall it's below the industry average of about 9%, slightly below the industry average. So overall costs have been, they're not growing in line with market. The industry average for R&D is 10% and it's only growing at 6%. Industry average for cost of revenue is about 9% and growing at 8%. So yeah, the costs are increasing but below market, below the industry average. Now the slow rate of cost is due to a large degree to margin as well as profit protection. It makes sense since the market is heavily competitive. Spending is to be wise and methodical. R&D as a percentage of revenue is below the industry average of about 20%. Again, makes 100% sense. Low margin industry is not really gonna go all out in R&D. Not that you don't want to, but because it doesn't make sense to say you're operating a very low margin industry. But the good news is that the R&D as a percentage of revenue has been stable. Revenue growth is below the industry average. Industry average is about 8%. Now you can argue, which I am right now, that these costs are providing some form of return. I mean, it's below industry average, but even though not spending that much, it is providing some form of return and is resulting in very stable margins. Yeah, there is some form of return, even though it's small. The same can be said with the net income. There is a return. It is small, but there is a return. The return on equity has been declining, which is not a good sign. Overall, however, ST Microelectronics is very profitable. The financials indicate that it's a very well-run company, but does operate in a very competitive market. Adding COVID into that just makes this a meh company. I mean, I'm neutral to it. These financials, I'm pretty neutral to it. Current ratio is above industry average. Industry average is about 2.37. So it has outperformed industry average. Good, strong indicator of liquidity. A solid sign that the balance sheet has limited liquidity risk, even though there has been some decline. But again, over this 2020, so you might have had to spend much cash on hand, to protect the industry from the effects of, to protect, the company from the effects of COVID. The asset test ratio above the industry average. Industry average is about 1.88. Same with the current ratio. Good performance, doesn't indicate heightened liquidity risk. Yeah, it's good overall. You know. Now both these ratios, the asset test and the current ratio, their overperformance that makes the balance sheet very attractive. From a liquidity point of view, very limited liquidity risk. This is driven by the over $3 billion in cash and cash equivalents that Microchip holds on its balance sheet. Inventory days are slightly above the industry average. The industry average is just over 101 days. It's at 100, just over 102, so slightly above. However, this does not indicate the heightened inventory risk in my view. Overall, still good good inventory management. Considering 2020 was a tough year for these semi manufacturers, considering I don't think they had to hold on to quite a lot more stock that they would have loved to, even stock that was manufactured for quite a long time to ship it because of supply chain disruptions. But overall, yeah, I mean, good liquidity, very, very good liquidity. So the risk caused by liquidity is very low on microelectronics balance sheet. Now the debt to equity ratio far below industry average. Industry average is 126, so it's below industry average, so it makes the balance sheet less risky. So overall, from a liquidity point of view, not risky. From a financial risk point of view, very low risk. It's a liquid, very attractive balance sheet. The cash position. The cash margin is below the industry average. Okay, not good. Not expected given the high levels of competition. But still does indicate that even though it's low, it does still indicate that the business model can generate cash from operations. The sufficiency of cash flow is above the industry average. Industry average is about 0.84, so a very good indicator. Also highlights the strong cash flow position ST Microelectronics is in. Reward shareholders at a pretty fair-ish rate. PE, however, for me, not that high considering the industry average is about 40 and it's trading at a PE of almost 36, so below the industry average. However, microelectronics for me, I don't know, it's a bit of a meh company, not too good, not too bad, just in the middle, but there are companies in the sector that can give you better returns in my view. Lamb Research, supplier of wafer fabrication equipment and services to the semi industry. So it's one of those semi equipment makers. All right, net income in line with industry average at 27%. Has been appreciating, overall very pleasing performance. Costs have been increasing significantly, but has not resulted in a depreciation of margins. That is a strong indicator that costs are justified in achieving returns for the top and the bottom line. Very good. R&D as a percentage of revenue only slightly below the industry average. Industry average is 13%. The average for Lamb Research is 12%, so only slightly, so not worrying considering the solid performance of the margins, mainly due to the rising revenue, as well as a clear indication that costs are being incurred with the ultimate intention and realization of achieving returns. So costs are basically justified. I just said a bunch of nonsense, but basically costs are being incurred and are resulting in a realization of returns in the form of growing revenue and growing net income. So good performance, revenue has been growing at an accelerated rate, which has, improved margins significantly as well as improved net income also significantly. Return on equity is very impressive because it's above the industry average of 53%. A good indication that Lamb Research has effective procedures in place to realize above industry returns from operations on which capital is invested. The financial position. Now, the current ratio is well above the industry average. Strong performance in this metric. There has been a deterioration, but nothing too extreme. The same applies with the asset test ratio. Strong performance above industry average of 2.1. So both these ratios highlight a strong liquidity position that Lam Research finds itself in. Since the performance is above industry, this highlights a very attractive balance sheet that has very little liquidity risk. Inventory days are below the industry average. Industry average is about 100, just over 160 days. Highlights that Lam does not keep inventory for longer than needed. Low inventory risk in the form of inventory obsolescence and high high holding costs eating into margins and a very low liquidity risk. So that is what this low inventory level suggests. You will see in 2021 it's at 125, but overall, even looking at 2021, the industry average is still 160 days. So overall, good performance. Looking at my asset test, current ratio as well as my inventory days, very attractive balance sheet from a liquidity point of view with very low liquidity risk. The debt to equity is below the industry average of 171%. Again, it's normal for these entities to have high debt levels, but you don't want it to be so extreme that it's above the industry norm. So the fact that the debt to equity is at 161 below the industry norm, that's very good. That indicates that the balance sheet is not that risky from a financial risk point of view. It has very low financial risk. So good, solid, attractive, low risk balance sheet. We look at the relationship between risk, debt, and return. There's a productive relationship there. So overall, very good performance. The cash position. The cash margin is pleasing. It's in line with the industry average of 26%. They have declined from 2019, but still stable and has recovered in 2021. A good performance there, very, very good performance there. The cash margin highlights Lamb's ability to make cash operations. The sufficiency of cash flow slightly underperformed the industry average of 0.66, but ultimately satisfied, not significantly underperforming the industry average. Most cash that Lamb generates does go into rewarding shareholders. Very common in this industry that entities we don't like holding on to too much cash on the balance sheet. We prefer to reward shareholders. Yeah. So from the cash position that Lamb finds itself in, the solid one. It's it's a pleasing one. It's a really, really pleasing one. All right. The returns that it provides. Provides a lot of returns, as we said. We need these companies we don't like holding on to too much cash. The PE relatively cheap, very, very, very cheap company. I mean, at 21, just over 21, very cheap PE. Um, Good company overall, performing relatively well. Yeah, but you know, I just think I could put my money elsewhere. I think I could earn a better return. So, but I mean, it is a very good company. I think even if one puts their money in Lamb, it's still a good investment. But given uh, I think other companies, I'd rather put my capital somewhere else. But still, overall, very very good company. No no complaints there. AMD. So AMD offers semis, GPUs, services and software that can be used as a platform to help other developers design and develop semis, as well as it licenses its IP. Full disclosure, I own AMD. Good stock, good performer for me, but I'll get into more on my ownership a bit later on in the video. Okay, so the financial performance of AMD. Net income margins are very tight, incredibly tight, quite small actually, below the industry average of 18%. However, you can see that they have been improving. Now that is a good sign. Now that is a heartwarming sign. Now it's important to understand why the margins are so tight. Number one, it operates in a very, very, very competitive industry. Even though there are high margins in this industry it operates in, it's very, very competitive. You will notice, when you do more research on AMD, you will realize, like I did, that in some segments, you know, even though in some segments it has caught up, or in certain cases its market share exceeds that of established players like Intel, to get there it had to spend quite a lot in order to get there to the cost. So in some segments, it is trailing market leaders. For in the GPU market, it is trailing Nvidia significantly, but it is making aggressive headwinds. So the low margins can be associated with the cost spending to improve market share. Now, looking at the cost, because we're saying, it spends a lot to improve market share, and it does. The industry average for cost of revenue growth is about 9%. AMD is sitting at 17%, so almost double what the industry is spending. The same applies to the R&D growth. Its spending on R&D has been growing at a compound rate of about 19% over the 3-year period, 2018, 2019, 2020. That's almost double the industry average of about 10%. So the performance highlights that AMD is chasing growth, but it's still a well-run company because margins are not deteriorating, margins are not in the dumpster fire. So it's still a well-run company. It is chasing growth, but it's chasing growth and at the same time achieving positive margins and protecting profitability. Revenue as a percentage of R&D, my bad, R&D as a percentage of revenue, R&D as a percentage of revenue, it's above the industry average. Industry average is about 20%, and AMD spends on average 22%. So it again explains the growth trajectory, the growth strategy that AMD on. It's willing to spend significantly to not only grow but also maintain its market share. Now, the strategy does appear to be working because when you consider that net income margins have more than doubled, we went from 6% to 13% in 2020, so 2020. Furthermore, revenue has been increasing at a compound rate over the same 3-year period of 24%. Way above the industry average of 8%. So costs are justified in achieving returns on both the top and bottom line. So there is a return that AMD is achieving on its production cost in achieving growth in the top and bottom line. The ROE, however, below the industry average of 26%, but you can live with it. That's because the ROE performance does indicate that AMD is able to generate returns on operations from the equity invested. And considering, the other margin, the other metrics, margin, performance in cost, as well as growth, in my top and bottom line, I can except the performance in the ROE. The financial performance, starting off with the current ratio, it's been improving below the industry average of 2.37, but the performance is still satisfying because it's been improving, stable, is strong, shows that AMD does on average have well over two current assets per the current liability. So current asset exceeds current liabilities by a factor of just over 2. The asset test ratio, again, below the industry average. Industry average is 1.88, but it's been improving. And looking at the rate it's at, it indicates that AMD does have sufficient liquid assets to cover liquid liabilities. So on average, liquid assets exceeds current liabilities by a factor of over 1. In 2020, it's actually almost close to 2. So that one can live with. That is satisfying to a degree. Now, considering that both the current and the asset test ratio have been improving, and the performance is not radically disappointing. It is comforting to see that AMD does have enough current and liquid assets on the balance sheet to settle current liabilities. Thus, there's no real liquidity risk. The balance sheet is significantly liquid enough in my view. The inventory days have overperformed the industry average. Industry average for inventory days is about just over 101 days. On average, AMD's inventory days are at 7. So there is an overperformance in relation to the industry. It's a good indicator of liquidity, supported by the asset test ratio as well as the current ratio. It shows that there's no liquidity burden on AMD's balance sheet. Now, AMD's debt to equity has significantly improved. I mean, my goodness, it has more than reduced its debts from 2019 to 2020. I mean, there's been a significant improvement there. It's still above on average the industry average of 126%, but there is a pleasing trend, because what's happening? It's been decreasing. So it's a very so this performance, this decreasing performance, this improvement is very pleasing. It makes the balance sheet very attractive, and it makes AMD not that financially risky. Not have that much financial risk on the balance sheet. So overall, low financial risk, low liquidity risk, good attractive balance sheet. The financial position, so as well as the financial position of AMD is pretty good. Now the cash position. Now the cash margin, very little, very little. I mean, 1, 7, 11%. There is an improvement, but it's very little compared to the industry average of about 32%. It is quite disappointing at first glance, but when you consider the strategic position that AMD has adopted, it is understandable. It's important to note that the margin does indicate that AMD can at least generate cash from its operations. So on average, it generates about 6% of cash from revenues. In 2020, it's 11%. So but that again just highlights the strong improvement in margins. So overall, yes, it is disappointing, but it does show you that operations do at least generate cash. AMD is not just mindlessly burning through cash, as evidenced by the fact that the sufficiency of cash flow on average at just over 1 is above the industry average of 0.84. So, these two ratios combined, when you read them together, it shows you that the business model does generate cash from operations. It does have enough cash to settle, things such as debt and investing in operations to achieve, long-term shareholder rewards. So it is the cash position is decent. It shows a growing company that is well run, that does actually have cash. So both ratios are impressive. They've been significantly improving. Happy with that. Not rewarding shareholders at this stage, but that is understandable considering its strategy is more pivoted towards growth. So that is understandable. I don't have a problem with that. The PE is quite high, at just over 55. It's actually above the industry average, which is about just over 40. So it is a very expensive stock. But when you consider the fact that you are buying high quality growth, does in a bit make sense. It is high, but does make sense, considering what you're buying. So all of the above, when you consider the fact that it has a positive cash flow position with an attractive balance sheet and a strategic outlook that's geared towards growth, and that expenses, even though they are high, are not wreaking havoc on the growth market. Yes, they are growing, but they're not growing at the expense of profitability. Overall, in my view, it's a good company. Yeah, quite expensive considering the PE is trading at, but you consider what you're getting. I don't think, so relative to what you're getting, I don't think AMD is that expensive. I think it is an affordable stock. You can see that there has been a decline in the stock, but that's just that market correction that has been happening since the beginning of the year. But still, in my view, still a good stock. All right, that's enough about AMD. Moving on. NXP Semiconductor, global semi company. Offers a broad range of semi and related services, mainly to the automotive industry. So it makes semis mainly for the car industry. Financial performance. The net income margin has taken an absolute beating. Thanos in heaven, this is just really bad. So yeah, the margins have really taken a beating. They've been going downhill faster than a Prince Andrew interview. Uh, but the deterioration, can be summed up by increase in competition. It does operate in that sector of the market with tight margins as well as difficult, intense competition is normal, as well as COVID, which has just made things worse. Now, costs have either been decreasing or increasing at a decreasing rate. Right now, this is as a response to the difficult operating conditions. So you're not gonna really spend that much on cost when you're really not growing revenue and when your margins are actually at zero. So yeah, difficult operating environment has really taken a hit on profitability. The R&D, you can see, is slightly below the R&D as a percentage of revenue, slightly below the industry average. At an average of about 19, the industry average is about 20%. So slightly below the industry average. Not too concerning, given that it's not too far behind the industry standard. However, the negative revenue just highlights the loss of market share, which is caused by increased competition, as well as the deteriorating market conditions caused by COVID. Wow. COVID just really made a difficult, bad situation even worse. The decline in the net income at the 101%, just highlights and follows a trend of loosening of declining sales, increasing competition, COVID hampering the supply chain. So, the profitability overall of NXP Semiconductors has just been really poor. Um, the ROE, you really don't expect much from it, considering margins are just horrible and declining, and the return on equity just follows that trend. It's really awful, but understandable considering NXP is not really making any money. It's actually losing. So, but let's see the financial position. The financial performance has been horrible, absolutely horrid. So hopefully the balance sheet is attractive enough. So the current ratio's performance underwhelming compared to the industry average. Industry average is about 2.37 on average. NXP's current ratio is about 1.84, so very disappointing there. The ratio, however, has been improved from 2018, 2019, and 2020. Okay, that's a good performance. Um, so it's really not a bad thing when you consider that NXP is really not making any money. It's actually losing money. It has just an absolute no margins, losing in terms of profitability and market share, but it's still improving its balance sheet. So that's pretty good. That's pretty good. The asset test, same thing. The market is in absolute decay, but the balance sheet is still liquid enough. It's still below the industry average. Industry average for the asset test is about 1.88, but it's been improving, considering that the market is in disarray. The balance sheet is at least liquid. It does not have a significant heightened liquidity risk. That's good. So both performances are worrying, but considering that both performances of the asset test and the current ratio are a bit worrying, but considering where the margin is and considering the fact that it has been growing, not that bad. All right, now the debt to equity ratio of NXP, keeping the industry base for a bit, I'll get there, but the debt to equity ratio is below the industry average. Industry average is about 126% and NXP is at 111. Now there has been a significant increase. Now this increase follows the fact that NXP is really not making any money. Looking at the declining margins, declining sales, declining net income, is not making any money. So as a result, it's kind of borrowing a bit to show up and strengthen its balance sheet. And the increase in the debt to equity explains, so the increase in debt basically explains the good performance of my liquidity ratios. So you're bolstering your liquidity. So NXP has been bolstering its liquidity in response to the fact that it's really been performing horribly. Difficult market condition, COVID making our worst situation even worse. So, all right, so they have been improving debt, increasing debt to improve liquidity. Not a bad thing considering that overall, on average, the ratio is still below the industry average. All right, not bad. So not an increased financial risk. It's actually a good use of debt just to strengthen your balance sheet. Give yourself a strong performance to actually compete and survive and weather the difficult trading environment, the difficult, operating environment. So very, very good there. Um, the balance sheet is still positive, low-ish liquidity risk, not increased financial risk considering that the debt equity is below the industry average. So all right, overall, one can live with that. The inventory days are below the industry average. The industry average is about just over 101 days. On average, NXP's inventory days are sitting at 96 days, just over 96 days. So overall good, it paints a good picture of liquidity, shows that NXP is not holding on for um, still holding on to inventory for way longer than it needs to, and you can see it has been improving. It is a good thing considering margins are tight and margins are under pressure. So it is selling what it can sell, not making way more than what is needed, and probably putting unnecessary pressure and burden on margin. So very good. The inventory days just support a good liquidity position that this balance sheet is in. It's not that attractive, but the balance sheet is at least good. Now the cash position. The cash margin portrays a worrying image of a company that which is declining a bit in its ability to generate cash. So a bit of a worrying picture. good rebound in 2020 from 2019. In 2020, the decline, the rot was at least stopped. Um, Overall, the ratio is above the industry average. However, the cash flow from operations margin, the cash margins, they are a bit worrying, considering, you know, COVID is really wreaking havoc on this company, on NXP, as well as the difficult uh, market conditions. So it is good. I mean, it's above the industry average 32%, but it worries me. So the sufficiency of cash flow is below the industry average of 0.84, which when you read with the declining margins, it really makes me a bit nervous. I mean, yes, in 2020 the rot was stopped, but still, the cash position just makes me a bit nervous. I mean, don't get me wrong, NXP's business model can generate cash from operations, which is good. It does generate cash from operations, and it does, at the end of the day, have cash available, to fund all operating activities. But it is worrying a bit, like when I consider the fact that it's not selling as much as it should. Revenues are in decline. Yeah, revenues are in decline, not really making any money. A bit worrying for me. A bit worried, So, it's operating in difficult environment. COVID is wreaking havoc on it. Yeah, this company makes me a bit nervous. So the total return yield has dramatically reduced. So what NXP returns to shareholders has been dramatically reduced, and that makes sense. The market conditions are worsening and it's finding itself in a very, very difficult position. It's not going to pay as much return, as much to shareholders as it would have in the good old days. And the PE ratio is totally insane. It makes no sense. It is crazy. It is beyond expensive. That is just a ludicrous PE ratio in my view. So look, overall, good liquidity, but horrible financial performance. The cash burn is a bit worrying. Now, the only reason, you know, shareholders are probably, investors are sticking with this company, considering it has such a ridiculous PE ratio, is, mainly because it does pay out quite a lot. It does return quite a lot to shareholders. But to me, not. It's a no-no for me. It's too expensive. Operating in a very difficult market, and it's really, really, really struggling. Okay, just a conclusion. Now we're at the conclusion phase of our video. My stock picks are Nvidia and AMD. Now these are the ones that I would consider and about. Like I said, I do own Nvidia and I do own AMD, and they have been pretty good to me. I'm still in the green for them. I mean, if it wasn't for them, my portfolio would look really horrible. So I got into them, when they were still relatively low, and I'm still in the green, even though there's been a massive overselling and market correction. But I'm still performing pretty well. They've still been performing pretty well in my portfolio. So they are my stock picks. Synopsis, I would put on the watch list. It's a good company. It's really, really attractive. The only thing that turns me off it is its high PE. Synopsis has a PE of almost 60. That is too high for me. You know, if its PE can just go between 45 and 50, for me, it will be a buy. So I would keep Synopsis on the watch list and just keep a keen eye on a PE. I would just keep a keen eye on the PE, at a price when it is affordable to me. Marvel Technology as well finds itself on my watch list. However, it is trading at a price to sales, and I'm only keeping an eye on it because I like the Marvel Marvel Technology story. If only can achieve sustained profitability, I would get into it. But it's on my watch list, but only if it can achieve sustainable profit, I will consider buying. Applied materials, also one that finds itself on my list. Um, I'm like I was sufficiently pleased with its performance, and considering the fact that it's trading at a affordable PE, that's why I find itself on my watch list. I would just wait for a while. I would just wait for a while. Before going into applied materials, just seeing the overall effect of the supply chain disruption. Should I feel like the supply chain is cleaning itself up, it's getting to pre-pandemic level, there is light at the end of the tunnel, then I would put some money in that. Aerial. TSMC, Taiwan Semi. Again, on my watch list because I believe that it's trading at a massive discount. And should tensions with China subside, you could see Taiwan Semi going through a massive valuation. Boom. All right, and that's my story. Goodbye.